Pandemic in the short term, but with a plan to raise taxes to the highest level since the 1960s. Let's take a look at your futures then. 20 seconds or so to go until the start of European equity trading, and we are expecting moves to the downside. And a lot of this has to do with the rising yield environment, but actually yields on treasuries coming down a little bit just this morning. So we see 1.44 is now the handle on the US 10-year, flirting certainly with that 1.45 level, but it's not 1.6. It's not the levels that we got to just in last week's trading session, but it was enough to take the edge off US trading yesterday, and so we expect it to take the edge off European trading today. We saw the Nasdaq under considerable pressure yesterday, down by more than 2% in session, down by more than 2.5% in session, erasing almost gains for 2021, certainly hitting a 2-month low. And so that is certainly a part of the story. Where will those, how does that translate into the European trading day? Because that tech leadership hasn't necessarily been the story that Europe has been trading on in recent sessions anyway. So we see how this all plays out for European equity markets. And you can see that, as expected, we see some moves to the downside. Bear in mind, we got gains on some of these European equity markets yesterday. Certainly the FTSE 100 was stronger on the back of some of the news around the budget, but the FTSE today down by 0.6%. The CAC is opening to the downside, down by 0.5%. And this follows a session in Asia which was weighed down by the global yield story and a sell-off in tech. So European equity markets opening a little bit lower this morning. That is after that overnight surge in sovereign bond yields has dragged down stocks on Wall Street, and also in Asia, tumbling Chinese stocks led the losses, with the MSCI Asia Pacific gauge seeing its worst drop this week. Joining us now is Piers Hillier, Royal London Asset Manager.
Good morning, traders. Hope you had a good evening, good night. Right straight after yesterday's, when we cancelled order to sell, to stop on the Euro USD, against United States dollar position, we place an again stop on profit at 120.60.5. Okay. Order placed. So as you can see, yesterday we opened position at 120.70.5. Just up, I'll show you right there. And all of you who followed our trades, supposed to place right now order at 120.60.5. So overnight we got 10 pips in profit. Okay, and now we will see how far or how good profit we're going to get from this trade, this position. Okay, I'll speak to you later, guys.
Or even under 1.5%, look too low. So it's a perfectly logical move at this stage. The real question, though, is, in the inflation question is the one that's popped up so much recently. Is this, driven by inflationary concerns, or is it just normalization? I think in the first instance, it's normalization. We are looking at a rise in commodity prices, which is classically indicative of a concern around inflation or growth demands coming through. So we'll watch that closely. But it's not obvious to me at the moment that that's transmitting into inflation. And I think the important thing is for us to really start to get concerned about inflation is do we see it in wages? And with unemployment where it is and the jobs data where it is, that's not obvious that that's coming anytime soon. But I think we don't want to be complacent. The only one thing just to add here is I know that that's a playbook that worked coming out of the global financial crisis, where essentially we were seeing monetary stimulus and concerns that that monetary stimulus was going to create inflation. Part of the reason that didn't happen last time is that we didn't have a fiscal stimulus at the same time, and we were basically actually we were tightening budgets and being more fiscally disciplined at that point. So the monetary stimulus was in some ways being offset by fiscal prudence. At this point, we've seen obviously huge fiscal stimulus put through not only in the UK but particularly in the US with the most recent $1.9 trillion Biden proposal, and potentially more to follow if they talk about infrastructure investments in the United States. And that's the bit that I think markets worry about is does that then trigger inflation?
Okay, and it's that inflation conversation I wanted to get to. You don't seem too nervous about the inflation picture, but we did see US break-evens hitting 2.5%. This is the 5-year break-evens, so that one measure of market expectations around inflation. We saw that happening yesterday. That's the highest since 2008. Admittedly, inflation hasn't been perhaps at worrying levels in the intervening period. But what do you take away from that kind of move in break-evens?
So there's two bits here. There's what I might describe as cyclical inflation and structural inflation. So will we see more than 2.5% inflation this year? Highly likely. That's just the way statistics work. You measure inflation on year cycles. So effectively, we had deflation with that economic slowdown last year. You'll naturally see that feed through into cyclical inflation this year. The question really, and my earlier comments, are around structural inflation. Do we start to then see that feed through into wages, into significant output cost prices? So we've seen the start of input price inflation, that's commodity driven at this stage. Does that convert into output price inflation and then into in terms of increased wage demands from consumers as they face that inflationary burden? And that's not obvious yet, but it's something we need to keep a close eye on.
Okay, Piers, thanks very much. Stay with us. Piers Healy, Royal London Asset Management CIO. We'll be back to Piers shortly to pick up the conversation around fiscal stimulus. Coming up here on the programme next, though, we speak to the CEO of Germany's Merck, Stefan Oschmann, after the company forecasts record earnings as COVID boosts demand in part of its business. We'll talk about what 2021 has in store next. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Okay, guys, let's put our stop on profit for euro even further to 120.55.5. We moved further 5 pips in advantage to our position.
In lab testing and for developing COVID vaccines. Joining us now is Stefan Oschmann, who is Merck's CEO. Stefan, good to speak to you. Thanks for joining us today. You've given us this prediction then of record profits in 2021. I wonder how much of that is to do with the pandemic. You're seeing high demand, of course, for supplies, for vaccines, for therapies, for tests and the like. Is that something that you're counting on continuing through 2021?
Merck has 3 different businesses. We have our biopharma business, our life science business, and our electronics business. The biopharma business was in 2020 slightly negatively affected through the consequences of the lockdown, but has recovered very well and is performing excellently. Our life science business that caters to the needs of researchers and biotech companies and vaccines companies is benefiting from additional demand in the diagnostics, the therapeutics and the vaccines space. We have good visibility as to our order books and we expect this trend to continue for quite a while. Our semiconductor or electronics business is performing very well too. We're all living in this digital world nowadays and people need more and more laptops and servers and semiconductor manufacturing is very hot these days. So we think that these trends are more long-term.
Yes, I'll return to semiconductors in just a moment, but just to stick with the pandemic, Stefan, and your expert assessments of where we are there, are you more or less optimistic than you were back in January about the trajectory of the pandemic? How do you see 2021 panning out?
Well, the fact that we have several vaccines registered after less than a year that the pandemic hit us is actually absolutely encouraging. We have high quality vaccines in the market. We do assume, however, that the virus might be endemic in future and that this will develop into an influenza type of situation where with new variants emanating, we will have to get re-vaccinated routinely. That is not a given, but that could be possible.
That's interesting. And I wonder on the vaccination, Stefan, whether you think Europe needs any kinds of rethink. The rate of vaccination lags in continental Europe versus the UK and versus the United States. You talk a lot to other pharmaceutical chiefs, to governments, and I wonder if you think a big change is needed to increase the pace.
Well, I think that it was fairly evident that when we saw the phase 2 data of some of the major vaccine players, especially BioNTech, Moderna, in the middle last year, that there would be a high probability for these vaccines to really work. Different governments have shown different approaches to this. However, whatever governments could have done, there are plenty of technical and scientific challenges. So scaling up vaccine production is not a simple task. So all in all, vaccine supplies are improving greatly, and I'm very confident that we will have enough vaccine available to vaccinate everybody who wants to be vaccinated by middle or slightly later this year. It is true that different countries perform differently. It's fantastic to see how well Israel has handled its situation, also how digitalized the Israeli healthcare system is, and how important it is to have real-world evidence data. What I hear from politicians across the world, and mostly from Europe, is that people have been sensitized to the need to make our healthcare systems more effective and more resilient.
That's an interesting perspective. The World Health Organization has also been warning that we potentially face what they call a moral crisis, given an inability to spread vaccines around the world effectively. Stefan, do you think about that?
I feel, or I observe, that there is unprecedented collaboration between governments, international institutions, industry, academia. We have important initiatives such as COVAX, CEPI, and so on. So never ever in human history has there been more collaboration on this. Yes, we do have issues. We must make sure that everybody gets equitable access to these vaccines, but I see more progress than ever before. So I don't want to be a pessimist about this.
Okay, let's not be pessimistic then in this year of all years. You mentioned the diversity of the business, or the scope of the business. It operates in different areas, Stefan, one of those being semiconductors. We're seeing strong demand for chips. We're also seeing disruption and shortages in certain types of chips. How is this playing out for your business, either in terms of pricing power or supply chains? What impact is that having on you?
Yeah, so we have become, through organic growth and various acquisitions, most recently the acquisition of Versum Materials, we've become a leader in semiconductor materials worldwide. And this market is truly booming. Most people believe that the fact that we can communicate digitally as we do is mostly about software. It is very much about hardware. And therefore, semiconductor manufacturers are working at full capacity, or even beyond that. We have no capacity constraints in our manufacturing, but we're working at full speed, and we are very confident that this is a long-term trend.
Okay, no capacity constraints. Thanks very much, Stefan. Really good to speak to you. Stefan Oschmann, the CEO of Germany's Merck. Let's take a look at some of the stocks that are on the move this morning. Danny Berger has a rundown of some that have caught her eye. Danny.
And sticking in Germany to start with, Lufthansa falling today. It's after they posted a record loss for 2020 and had to cut their capacity forecast for this year. At the high end, they see as much as 50% of 2019. Previously, it was 60%, so that's why we're seeing it take a hit. To the upside, though, in the UK is B&M. The retailer seeing strong margins when it comes, especially for their UK business, upgrading their forecast for the year. Morgan Stanley saying that this should be taken positively. It is up nearly 1%. Now, finally, also to the downside is Rio Tinto. We're seeing a lot of the miners today do pretty poorly. In fact, the base materials sector, one of the worst performing in the S&P 500, as some of those metal prices drop today. Rio Tinto also has the added pressure of the chair resigning over the Aboriginal crisis of moving on one of those sites, saying that he is taking responsibility. Let me give you a quick look of the macro picture as well. Yesterday, we had that big sell-off, especially in tech names. Now, we are seeing the U.S. 10-year yield stabilize a bit. There is a slight bit of buying there, which has been interesting considering that the job numbers even missed yesterday. Still, we're getting that inflation, that froth concern. We saw Asia take a pretty big hit during the trading, and that is somewhat seeping over into the European session, though U.S. futures have been wobbling back and forth. But at the moment, Stock 600 down more than 0.5%, Anna.
Danny, thank you very much. Danny Berger with the latest on some of the movers here in Europe and indeed over on the Asian session, which we are keeping an eye on closely. Up next on the programme, we focus in, though, on the UK as Chancellor Rishi Sunak plans the highest taxes since the 1960s to pay the pandemic bill. Details next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the European Market Open. 20 minutes into our European trading session, and we've got European equity markets moving to the downside. Just want to point out to you something that is expected to happen in around 4 minutes' time, and that is a SpaceX launch. We're bringing you live pictures this morning. SpaceX Falcon 9 rocket is set to launch. It is set to launch the latest batch of Starlink satellites into orbit from the Kennedy Space Center in Florida. So we're keeping an eye on that. The launch time, as I say, is in around 3 minutes' time now. So we'll keep an eye on it, and we'll bring you pictures as they come to us. Back to the UK economic story, and the Chancellor Rishi Sunak will keep up record amounts of spending to help the economy through the coronavirus. With the country still in the midst of the pandemic, he used his budget to make it clear that saving jobs is his top priority. He's also, though, raising the UK's tax burden to the highest in more than 50 years to begin paying down debt. Piers Healy at Royal London Asset Management CIO is still with us. And Piers, because of the timing of these measures, do you think he has walked the right path here? There were a lot of noises before this budget saying it is too soon to start tightening taxes or picking up taxes. He is picking up taxes, corporate tax, bracket creep on income tax and others. So there is a lot more tax take coming, but it's not coming just yet. Has he threaded this needle right?
Yeah, I think it was right to continue the stimulus in the short term. You know, we actually haven't come out of lockdown yet. You've not seen a lot of the sectors impacted by the slowdown recover. So we needed that continued support. So I think that was the right thing to do. I'm a little surprised it's such a big step. That's the big, that's the big change you're referring to as a headline this morning. I would have thought actually some form of stepped approach would have been better for corporates to be able to manage that. I worry that we'll get some creative accounting that seeks to manage tax burdens when you get such a big step like that. On the plus side, he's really incentivized companies to invest and put capex in to support business growth. And I think that's really supportive of the economy at this point. It'll help from a job formation perspective. If one area I might just draw out was a bit disappointing was on the sort of support for the high street. I thought he might do a little bit more with respect to signalling what he might do on rates to support retail. And there's no mention of any form of digital tax at all. And that's something that had been floated for some time over the last sort of few months. One other positive is on what we've sort of come to know as the green gilts space. There's certainly an indication for the government to want to look to build a program there to support infrastructure investment into green-related assets, etc. And I have to say, we strongly encourage the government to do that, but do it in a ring-fenced way where investors are critical and can clearly see that the investments they're making are supporting that transition from a carbon-based economy to a renewable-based economy, for example, in energy generation, but also how we can support infrastructure investment. So, the electrification of our communities to support the transition from petrol and diesel cars through to electric cars. So I do think they can be a little bit more aspirational there, but they've certainly put a good signal out to start with.
Yes, I've been doing this job, Piers, for about 18 years, and I'm not sure there's ever been a budget where we haven't heard calls from the retail sector to change the business rates, but that certainly has become louder in the most recent period, hasn't it? So that's certainly one thing we'll look to see if we get any developments on in future. In terms of the online taxation question that you raise, I wonder with the new administration in the US whether you think actually there is going to be some concerted action, some ability to tax some of these profits from online businesses that manage to be very movable around the world, and whether there's going to be progress at a sort of global level on that. The OECD has been looking at that for a long time.
You make an excellent point, Anna. That's been the challenge, that you'll just seek to book profits in a different geography and therefore you avoid paying it. But if you actually do it at the turnover level and you then allow for the deduction at the net level, you can actually achieve that objective. And particularly for companies that are looking to deliver to consumers or to businesses, the registered address of that business, is an easily identifiable point from a taxation point of view. So it is doable, but it works better on a concerted effort. I certainly agree with you that it's top of mind for the Biden administration in terms of looking at how do they solve part of the tax shortfall for themselves. But it is something that actually is in the art of the possible. So we certainly watch that one very carefully.
Piers, I'm not sure if this has happened to you before, but you find yourself filling half the screen, the other half
I'm
of the screen
competing with
being
Elon
filled by
Musk's rocket, yeah.
with a rocket. Yeah, absolutely. A SpaceX Falcon 9 rocket launching approximately 60 satellites, we understand, for SpaceX's Starlink broadband network. Once again, delayed mission, designated Starlink 17. This coming to us from NASA's Kennedy Space Center in Florida. Just a moment, though, to get back to you, Piers, at this point, as CIO of Royal London Asset Management, then any change to your portfolio since what you've heard from the budget yesterday?
Not specifically to the UK. I think we had sort of started to allocate more of our exposure to domestic within our UK portfolios. There was a reflection in some ways that with some of the headwinds of Brexit and some of the concerns that were there and COVID, that actually we would expect sort of the UK-centric businesses to outperform this year. Overall, we still think the UK market actually looks quite attractive. You're going to start to see a number of dividend payers that had to suspend dividends last year because of COVID start to pay. So actually there's a prospect not only from an income perspective in the UK market, but broadly speaking, you've got some cyclical beneficiaries as we start to see economic growth recovery.
Good conversation. Thanks very much, Piers. Thanks for bearing with us with the rocket as well. Piers Hillier, Royal London Asset Management CIO. This is Bloomberg.
Friday is Jobs Day on Bloomberg Television, the first full jobs report under the Biden administration. What will it mean for the new stimulus package? The February Jobs Report, Friday morning at 8:30 on Bloomberg Surveillance.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 30 minutes into our trading session. Weakness across the board, really, for European equity markets. The Stoxx 600 down by 0.6%. If we look at the sector picture, I should make the point we have some heavyweight ex-dividends today, which is impacting on some of the indexes. But if we look at the GRR, you can see where we are from a sector perspective. It's a pretty defensive run of things, isn't it? Utilities moving to the upside. Food, beverage and tobacco also moving to the upside. That and construction and everything else in negative territory. Basic resources, the biggest losing sector, and technology down by 1.6%. That was a weak spot on Wall Street. Also a weak spot for the Asian session as well overnight. Let's get a Bloomberg First Word News update. For that, here's Laura Wright.
Thanks, Anna. London is seeing a rising number of coronavirus infections as COVID-19's rate of decline across the country is slowing. Health Secretary Matt Hancock is describing the new study by Imperial College London as a cause for concern, adding that it is important we remain vigilant. In Germany, Chancellor Angela Merkel is setting out a plan to gradually reopen Europe's largest economy. Hairdressers restarted this week, with bookstores and even gardening centres back up and running next week. A number of restrictions, including the closure of hotels and restaurants, are being extended until March 28th. The European Union is vowing to take legal action against the UK for breaching the Brexit deal. It follows Number 10's decision to take unilateral action on trade rules relating to Northern Ireland, marking the second time Prime Minister Boris Johnson has declared his intention to break international law. It puts London on a collision course with Brussels. SpaceX has successfully landed a Starship prototype rocket, the third test flight for its newest and biggest vessel, but just moments later it exploded into a fireball. Despite the mishap, the test is still likely a sign of progress for SpaceX. It's planning to use the Starship to take up to 12 people to the moon in 2023. No one was hurt in the explosion and there were no reports of any injuries. Anna, I wonder if we would feel ready to take that flight to the moon. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura Wright, speak for yourself. I'm keeping my feet firmly implanted on solid ground. Laura Wright, thank you very much with the First Word News update. And of course, we've brought you since then another SpaceX launch. So we'll keep an eye on all of that action for you. Now, Deliveroo has selected London for its planned IPO. Now the city is enjoying its busiest start to the year for new listings since 2006. Activity may soon pick up even more. The UK is set to ease exchange rules, giving founders more control over newly public companies, something that Deliveroo is going to be taking advantage of soon. Danny Berger joins us, and this week she's covering the Super Return Conference, a private equity conference that's virtual this year, of course, Danny, and you're standing by with a guest. And we talked a lot this week about the change in the rules here in London.
Yeah, we certainly did, and it's going to be really interesting for the private equity space as well, who, of course, frequently list companies. And I am joined now by Christian Sinding, EQT CEO, who himself was on a virtual Super Return event earlier in the week. Christian, first off, thanks so much for joining. And of course, EQT, as one of the biggest private equity companies in Europe, do these rule changes giving founders more control when listing, does this sway your favor in terms of going on to the London exchanges versus elsewhere?
Yeah, we think the changes are quite positive, actually. And it's not just that founders can have more control. You can debate whether that's positive or negative, but it goes broader than this. It opens up for the opportunities for SPACs, which I think we come back to in a few minutes. And it makes it easier for companies in general to go public. So I think it's actually quite innovative by London to do this. And I'm impressed that they're doing it right now. So hopefully some of the other exchanges in Europe will also follow suit and make regulation more flexible and make it easier to take companies public.
Do you think this will pressure some of the other exchanges? Is there things that Europe needs to do to now be even with London should they adopt these rules?
I think so. I think Europe is actually easier in general than the US. So in that sense, we actually have an advantage. But I do think that there are a lot of differences across various countries, from Switzerland to Sweden to Paris to London. So to make an alignment around these kinds of let's say lessening the regulation or making it more commercial and actually simplifying the IPO process, because it is, particularly for smaller companies, it's incredibly heavy to go public in multiple different ways.
Well, Christian, you mentioned SPACs, not me, so might as well talk on it. I know last time we talked, you were kind of concerned about some of the governance issues along with SPACs, but of course we've seen so many more. That was back in December. Has your view changed on them at all?
Fundamentally not. I think the issue with SPACs, at least the ones that have, that are in the U.S., is that the fees around them are quite opaque and they're very short term. So it's really a structure where a lot of the advisors and the people setting up the SPACs make a relatively short term return, while the shareholders who are buying in, they're of course interested in owning something for much longer. So there's a disalignment of incentives. So what I'm hoping that will happen in Europe is that we can create SPACs, which I think is actually a helpful thing for certain companies. It could be an attractive way to go public a little bit quicker in companies that are in need for capital, or in companies where it's a little bit more, the story is a little bit more complicated and you need to dig in a little bit deeper into the business. So I'm hoping that actually with this change in London, that we can set up structures in SPACs in Europe which are more transparent with longer term incentives, and then have it be better aligned between shareholders and those who are doing the SPACs.
Yeah, I was going to say, I mean, how attractive is listing via SPAC to you versus a traditional IPO? If we do get this in London, perhaps we do get some reforms, as you say. Would this be perhaps the preferred route of going public?
I don't think so. I think it's going to be case by case. If you have a company which is ready to go public, it has all the systems and people in place, it's got a straightforward equity story, I think going public is a better route, because the process is actually set up so that you can choose, the long-term shareholders that you want, and the long-term shareholders can choose the company. The SPAC is a little bit more, a little bit quicker, and also you don't exactly know who's going to be the ultimate owners of the SPAC. So I think it's a tool, but I continue to believe that the IPO is a better route. But again, it needs to become simpler.
Christian, I also want to get your outlook for the rest of the year, because we did have the UK budget yesterday. We have just this immense amount of spending that at some point down the road for most countries, it's going to mean more taxes. How do you take advantage of that rotation we're likely to see in maybe the near, or at least kind of towards the end of the year?
Yeah, private equity, we're long-term investors. So what we're trying to do is we're trying to invest in the long-term trends of society. When we're owning companies for 5 years and then we're going to take it public thereafter, for example, then you need to think on a 10-year basis. So these, let's say, shorter-term moves in the markets don't necessarily change the way that we invest or act. But certainly we do think that once the pandemic is over, the vaccines rolled out in all the countries, we think there is going to be quite a short-term boom in many industries. And we think that's also going to lead to lots of transactions happening, both on the buy side and the sell side. So we're all, I think, very active right now in the financial markets, and we're driving a lot of exits and doing a number of deals. And I think that's going to really heat up towards the end of the year. I think it's going to be an exciting time. The one concern I think we have is that since there's so much activity, people aren't necessarily differentiating between the really good companies and the good opportunities and those that maybe sound good, but if you dig a little deeper, maybe they're a bit rusty.
So where are the biggest risks in there that people are perhaps bidding up too much, that are overvalued at this point?
Yeah, I think there's take leisure, travel, for example, even renewables, where there's a lot of capital going in and people expect huge momentum to come back. But it's still pretty difficult to see exactly, where are the energy markets going? Where's the capital going to move? Of course, it's going to be in renewables, but in what forms? How does regulation support you, et cetera? And then leisure and travel is still uncertain exactly how people are going to travel. What's in particular around business travel. So I think there are a lot of bets being taken now, and we're trying to think a little bit longer term and say, what are these trends that we really want to support? And then, for example, in the renewable space, we'd love to we own service companies that are supporting that sector, which are then maybe a little bit easier to work around for the longer term.
Right. Well, it's definitely interesting to see that ESG and reopening story come head to head. Christian Sinding, EQT CEO, thank you so much for joining us. Anna?
Danny, thank you very much. Interesting conversation. Danny Berger there with the EQT CEO. Just giving a few breaking lines from a political perspective here in the UK, or the relationship between the UK and the EU. The Deputy Prime Minister in Ireland, that's Leo Varadkar, saying that the UK Brexit moves are not appropriate. The EU won't overreact, though, to the UK's action. And just to remind you, this is the unilateral action that we saw the UK taking to extend a deadline from April the 1st. That had previously been agreed with the EU. The UK unilaterally deciding to extend that, which will allow the UK to waive customer paperwork on food entering Northern Ireland, something that the EU does not want to see. The EU has said it will take legal action. We'll continue to watch those developments. Coming up, but we're back to the budget conversation. We talked to the CEO of Make UK to see what that particular organisation made of the budget conversation. That's next. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal time for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds on the global economic recovery.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome back to the European Market Open, 43 minutes into a European session that actually is pairing some of its earlier losses. So we were in negative territory much more firmly earlier on. Now we see the CAC in positive territory, only just. The IBEX over in Spain also up by 0.2%. And this comes at a time where we see US equity market futures pairing earlier losses. And in fact, NASDAQ futures now just into positive territory. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Germany's financial watchdog BaFin has shuttered Greensill Bank and is asking law enforcement to investigate accounting irregularities at the lender. It adds to the trouble facing parent company Greensill Capital, which we're told is filing for insolvency as it tries to find a buyer. Societe Generale is cutting the bonus pool at its investment bank by about 20%. That's after trading hits handed the French bank its first losing year in more than 3 decades. Bloomberg sources say SocGen's market unit saw even bigger reductions, with some equity derivatives traders facing a bonus cut of more than 80%. Food delivery platform Deliveroo is planning to list its shares in London using reformed rules that will allow a dual-class structure. London is betting the changes that will give founders of these supercharged shares will help draw big IPOs to the city after Brexit. Deliveroo was founded in 2013 and was valued at more than $7 billion in January. That's the Bloomberg Business Flash. Anna.
Thanks very much, Laura Wright here in London. Coming up on today's agenda, things you need to know about today. OPEC Plus is holding a ministerial meeting. That's taking place via video conference. We see a little bit of upward momentum to the oil price this morning, $64.31 on the Brent price. The group is looking poised to agree a production increase as it seeks to cool a rapid rally in crude prices. That has certainly been much talked about. Are we in a commodity super cycle? That is very much part of the conversation at the moment. That conference taking place at 1 p.m. London time, so we'll have a look at that. Then over to the US later on, we get initial jobless claims. We'll find out if the downward trend seen last week is continuing, and that's at 1:30 p.m. London time. And finally, we'll be getting the latest thinking from the Fed on the recent bond market volatility. A much anticipated appearance from Chair Jerome Powell, certainly the highlight for the bond markets as we go through today. He's due to discuss the economy at 5 p.m. London time. Let's get back to the UK story here in the budget. Chancellor Rishi Sunak will keep up record amounts of spending to help the economy through the pandemic in the short term. With the country still in the midst of the crisis, he used his budget to make it clear that saving jobs is his top priority. But he's also raising the UK's tax burden to the highest in more than 50 years to begin paying down debt. But what does business think about this? Joining us now is Stephen Phipson, Make UK's CEO. Make UK represents manufacturers in the UK, of course. Very good to speak to you, Stephen. So your initial response here, I'm guessing that your members will welcome the extension of the furlough and indeed welcome the super tax deduction, which is supposed to encourage investments as well.
Oh, absolutely. So there was a really positive reaction to the Chancellor's statement yesterday on the budget, particularly around the, as you say, around the support schemes. There was a great fear that this was going to end in March, to see the extension of that through to September, whilst demand remains quite low. And the various other support packages, not just the job retention scheme, were absolutely vital. And we welcome that. That was very good to see it. I think the super deduction idea is a very positive one, although we have to realise it's quite short term. It's only for 2 years. So we've had a real issue, particularly through the pandemic, of course, with investment being way down in the sector and across business in general in the UK, down about 30%. So hopefully this is a method of restarting that investment, which is so vital for the future of these sectors.
Yeah, is this going to be the secret sauce that works to encourage businesses to invest for the future? Because the productivity conundrum in the UK has been something we've talked about for many years, Stephen. Is this going to be something that really works?
Well, we'll see. I think the Chancellor set out yesterday that it was a bit of an experiment. I think one of the other challenges we've got is that a lot of businesses have taken on a lot of debt in the pandemic. So it's about access as well to growth capital, and that's going to be part of it. That wasn't specifically addressed in the budget yesterday, but I think this is a very good initiative, certainly welcome, and we'll see what the effect is. Hopefully it can restart that investment cycle. That's so vital, and that's what we're looking for.
Yeah. Yeah, and what about response to the higher corporation tax? Of course, for many of your members, the impact of that might be cushioned by some of the exemptions from the higher rate. But this is the first increase in corporation tax since 1974. Are members focused on the need to repay in these exceptional times and the role they play in that? Or are members thinking, hang on, does this give the right impression for how open for business we are in the UK?
Well, I think there was an inevitability about it. Most businesses were realistic and realised there would have to be some tax rises to pay for this. I mean, obviously, for many, the scale of the increase is quite significant, and no one welcomes that. But at least the Chancellor was honest about it yesterday, and we welcome the honesty. That was good. And the question is, does that remain competitive? As other countries also try to rebalance their debt with corporation tax increases, does that keep us in the right place? The Chancellor thinks so, and that's his bet. And we'll have to see the reaction of businesses. But it was a large increase, definitely. No one likes it, but there is a realisation that we do have to repay these enormous sums of money that have been used in supporting businesses through the pandemic. Absolutely.
And were you disappointed about a lack of reference to Brexit? We know what the Chancellor thought about the Brexit decision before the vote took place, and there wasn't really much mention of it. Of course, the pandemic has loomed large and sort of pushed Brexit even off the domestic agenda in many cases. But I imagine many of your businesses are still getting used to the new trading relationships and adapting to them.
Oh, absolutely. I mean, the first few months have been very difficult for many exporters. And of course, this is just the start of the process. We have all the import restrictions to come in, and then we have further parts of the new agreement to come in throughout the rest of the year, which adds more burden to business. And we have been calling on the Chancellor and the Treasury to try to mitigate some of that with grants and support for businesses that are trying to export with these new processes. And it's been quite a challenge. And yes, it was a little disappointing that we didn't see that recognised in the budget yesterday. Doesn't mean we'll not continue on with Treasury talking about these issues and seeing if there are some mitigations, but there's no doubt as we get used to these new arrangements and we can see some of the challenges around that today, particularly around Northern Ireland, we need to build up a really strong partnership with the EU going forwards. And so we need to mitigate a lot of those actions. But yep, it wasn't recognised yesterday, but we'll continue on pressing the point. I think that's going to be important.
Stephen, thanks very much. Stephen Phipson, the Make UK CEO. 50 minutes into a European trading session that looks negative, but not as much as it was. Coming up, when will rising US yields begin to, or what impact will it have on risk assets? We'll certainly get into that conversation next. Ben Ram, Bloomberg's Markets Live currency and rate strategist, joins us next. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. 53 minutes into a negative session for European equity markets. US futures had recovered just a moment ago. Now they seem to have retreated back into negative territory. European shares then in the red, pausing after 3 days of gains. In Asia, tumbling Chinese stocks led the losses, with the MSCI Asia Pacific gauge seeing its worst drop this week. Joining us now, Ben Ram, Bloomberg Markets Live currency and rate strategist. And Ben, this is all to do with the selling that we've seen in Asia and here in Europe, all to do with concerns once again around higher Treasury yields. And I was interested to see what happened to break-evens yesterday, topping 2.5%, the highest since 2008. Does this measure of inflation expectations, is this moving the dial for you?
Yes, it's definitely moving the dial on a lot of assets, Anna. We have, in a sense that we've already seen it happen. The 10-year rate, the nominal rate, that is, has surged some 55 basis points so far this year. And that's enough of a portfolio shock for many funds, though I'm not too sure how many were actually positioned for it. With the 10-year rate moving that fast, the rate at which future cash flows on stocks is discounted is trending higher, which means that valuations go down. Stocks are already wobbly, and we have seen overvalued tech stocks in particular feeling the pinch. The truth is that the current valuations on NASDAQ are unsustainable over the long term. And if you see the spread between the NASDAQ earnings yield and 10-year treasuries, it's the lowest it's been in years. And I don't think that's sustainable over the long term. And as I wrote earlier this week, the longer the market refuses to bite the bullet, the deeper the pain. Anna?
Yeah. It's interesting, we're asking on the Markets Live blog today, I'm just reading your question of the day, how high a yield would crush risk assets? Well, if risk assets, if you define them as tech stocks, and if you're thinking just about tech stocks, and if you define crush as losing the gains of the year, then perhaps we're there already. I mean, what kind of levels are you looking at?
Well, I mean, if the Treasury 10-year yield climbs to 1.90 or 1.9% or thereabouts, I think that we will see a pretty sharp drop in NASDAQ and definitely in the S&P as well. And I think that we would be definitely seeing a drop of 15% plus from the top. And I don't think it's a question of if. It will definitely happen if Treasury rates keep climbing higher. Anna?
Ben, thanks very much. Thanks for joining us. 1.9%, I've written it down. We'll keep an eye out for that. Ben Ram, Bloomberg's Markets Live, currency and rate strategist. Thank you very much for joining us. That is it for the European Market Open. Surveillance Early Edition is up next. They'll keep an eye on these markets for you, of course, continuing to chart the impact that we've seen from higher Treasury yields on equity markets, on risk assets. Although worth pointing out that Treasury yields not on the rise this morning, 144.98, so around that 1.45 level this morning. Those yields moving down. We are buying treasuries today. Seems to be across the curve, that move as well. US futures point flat to negative right now. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected
as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Catch highlights from the City Lab Global Cities Summit this weekend on Bloomberg Television. The conversation surrounding cybersecurity, urban planning, and transportation. Plus, special guests, U.S. Department of Transportation Secretary Pete Buttigieg and Vice President of the United States, Kamala Harris.
Cities big and small are the heartbeat of our countries.
The City Lab Global Cities Summit this weekend on Bloomberg Television and Bloomberg Quick Take.
We are on the cusp of being able to fundamentally change the nature of this disease.
It is now the task of politics to take the next steps. They shouldn't throw us back and lead to a dramatic third wave.
Much has changed, but one thing has stayed the same. I said I would do whatever it takes.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on Thursday, the 4th of March. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Markets brace for volatility ahead of another appearance from the Fed Chair, Jay Powell. We speak to former ECB Vice President Victor Constancio about the sell-off in bonds, stocks, and futures slide. Rishi Sunak keeps up the crisis spending in his budget, but keeps an eye on the future with a plan to raise taxes to the highest level since the 1960s. The Shadow Chancellor Annalise Dodds joins the program. Plus, Bitcoin breaks back above $50,000 as Jeff Goodlack warns of the great reversion in the digital currency. We'll speak with the chief executive of the world's largest crypto exchange, Binance. Now let's get straight onto the markets and European stocks, starting the day with losses, but the downside move pales in comparison to the sell-off in Asia. The Nocta sentiment started with a massive slump on the Nasdaq, which took the tech-heavy index to a 2-month low. Our Markets Live strategists, though, are warning against reading too much into the relative calm in European markets. The tone, they say, is likely to be set once again when the U.S. session begins, with Jay Powell set to speak at an event this afternoon. Well, joining us for all of the market action is our Danny Berger. Danny, so let's just start with some size and scope. How bad was the sell-off yesterday?
Yeah, well, the NASDAQ 100 selling off more than 2% yesterday. I mean, look at the 5 days for the NASDAQ 100. I mean, all of it is due to this just at the end here. More than 4.5%. It is so bad. If you were invested in some of those big momentum type funds, ARK specifically, the ARK Innovation Fund, that is now in a bear market, falling more than 20% from the high. So you can see that really the yield jitters, the inflation concerns, it's really been taking the pain out on tech. Not a great time to be placed in some of those momentum names.
Danny, Melvin Capital, the short sellers caught on the wrong end of the GameStop saga, actually had a good month.
Yeah, so a little bit of a reprieve for them. So this is their return in February, down 53%. Again, it's that targeting against some of their short positions. Bloomberg has learned that in February, nearly a 22% return. They've changed their strategy. They've started to hire data scientists to look at the messages on Reddit and different social media channels. They're not taking as chunky as short positions. So a lot of changes there, Francine, but still, in order to undo this amount of pain, they still have a lot further to go. They need to gain about 75% worth of returns to break even. So not quite all clear yet, but for those invested in Melvin Capital, for Ken Griffin and Steve Cohen, who just put more money in at the end of January, it's certainly a promising sign.
Danny, Rishi Sunak's budget had some changes to listing rules in the UK. Is that affecting any big upcoming IPOs?
It really is. Just immediately after we heard this announcement of their plan today, we learned that Deliveroo is planning to list in London exchanges, and they're doing it on a dual class structure. And that's something that's part of the proposal. So presumably, if they don't get passed, then Deliveroo won't be listing in London. Look, already London has had an amazing start to the year in terms of listings. This is the highest amount since 2006. But it could get even more busy, Francine. I spoke to EQT CEO Christian Sinding just about an hour ago, who's the CEO of one of the biggest private equity firms in Europe, and he said this development was very positive. Take a listen.
We think the changes are quite positive, actually. And it's not just that founders can have more control. You can debate whether that's positive or negative. But it goes broader than this. It opens up for the opportunities for SPACs, which I think we come back to in a few minutes. And it makes it easier for companies in general to go public. So I think it's actually quite innovative by London to do this. And I'm impressed that they're doing it right now. So hopefully some of the other exchanges in Europe will also follow suit and make regulation more flexible and make it easier to take companies public.
Francine, I think this is a really interesting idea that London does this to catch up with the other exchanges for things like SPACs. And now Sinding, they're suggesting that it's everybody else who's going to have to play catch up to allow for easier listings. And who knows, maybe even more SPACs, because, we don't have enough already.
Yeah, we don't. We're missing a couple of SPACs. Yeah, I love the story that keeps on giving. Danny, thanks so much. Danny Berger there with the very latest on the markets she's watching. Now, Smart Conversations on Bloomberg Surveillance Early Edition. Later on in the program, we'll be speaking to the chief executive of Binance, the world's largest cryptocurrency exchange. We'll also discuss the UK budget with Rishi Sunak's opposition counterpart, Annalise Dodds. But up next, we speak to former ECB Vice President Vittor Constancio. You don't want to miss that interview, and this is Bloomberg. Are you?
I'm a leader that works on figuring out destinations that we should aim for and then chooses the direction.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. London is seeing a rising number of coronavirus infections as COVID-19's rate of decline across the country is slowing. Health Secretary Matt Hancock is describing the new study by Imperial College London as a cause for concern, adding that it is important we do remain vigilant. Now in Germany, Chancellor Angela Merkel is setting out a plan to gradually reopen Europe's largest economy. Hairdressers will restart this week, with bookstores and gardening centres back up and running next week. A number of restrictions, including the closure of hotels and restaurants, are being extended until March the 28th. The European Union is vowing to take legal action against the UK for breaching the Brexit deal. It follows Number 10's decision to take unilateral action on trade rules relating to Northern Ireland, making it the second time Prime Minister Boris Johnson has declared his intention to break international law. It puts London on a collision course with Brussels. And SpaceX has successfully landed a Starship prototype rocket, the third test flight for its newest and biggest vessel. But just moments later, it exploded into a fireball. Despite the mishap, the test is still likely a sign of progress for SpaceX. It is planning to use the Starship to take up to 12 people around the moon in 2023. No one was hurt in the explosion, and there were no reports of any injuries. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, I mean, the images, I have to say, were pretty extraordinary. Now, bond yields are stabilizing today after U.S. Treasuries tested the 1.5% mark again in yesterday's session. It was just a week ago that yields spiked to their highest in over a year, sending tech stocks spiraling and weighing on equities around the world. Well, even calm assurances of support from central bankers couldn't stop the market's growing fears over inflation. Former Vice President of the ECB, Vítor Constâncio, has drawn attention to an accompanying problem. He tweeted, "The spike of yields was accompanied by a new episode of lack of liquidity. This is a cause of concern and a call for reform after the more severe episode of March 2020." Well, Vítor Constâncio joins us now. Mr. Constâncio, thank you so much for being with us. I know I follow your tweeting and, of course, your thoughts very closely. When you look at what's been happening over the last 10 days, how worried are you that it's actually a lot more sinister given, you know, the rapid volatility, the rapid moves that we're seeing in the Treasury market?
Well, they indeed spiked last week, then they abated and more or less stayed calm this week. But it is a cause of concern because the episode last week was associated with a certain lack of liquidity, not comparable, of course, with the severe episode of last year in March. But nevertheless, it's a cause of concern. And then major investors like Warren Buffett, then J.B. Diamond, interviewed by Bloomberg 2 days ago, called that, you know, in the case of Diamond, that J.P. Morgan would not buy 10-year treasuries right now. All that adds to the concerns that markets are overreacting to wrong expectations about inflation in particular. There is also the issue of expectations of higher growth. There will be indeed much higher growth this year in the US, but what counts for medium long-term interest rates, it's indeed what will happen to long-term growth prospects and the potential output. And it's not yet clear how the advanced economies will get out of this pandemic crisis with higher potential growth or not, because investment has been lacking last year. And that's really what should be considered, and not just the cyclical recovery, which is always strong after a big depression like what happened last year. So it's the concerns about inflation that are also wrong in what the market...
So, Mr. Constâncio, given what you've just laid out, how should central banks deal with it? How should they look at the problem? And is there anything that they can do now to avoid a bigger concern further down the line?
Yeah, so far the increase in yields has been mild, and yields are still quite low. So central banks are doing nothing, are waiting, are explaining that the expectations of future inflation are really not what the markets seem to be perceived. Indeed, this year for one-off base effects on oil, or later on in the year, the materialization of the pent-up demand by consumers when vaccinations will be completed. All that will increase the inflation rate this year, and perhaps even a little bit more than present forecasts, but still below 2 for the year as a whole this year. There will be a big spike in April because of the oil base effect that can scare markets without really good analysis, because we have to see through these bumps in this year. And the deflationary forces are still structurally very, very strong. We have to consider that both in the US and in Europe, inflation has been for 25 years around 2%, very stable, despite of all the ups and downs in stimulus policies, the previous crisis and so on. Nothing really moved the stable inflation that advanced economies have been having for 25 years, and this will not be disturbed easily. So globalization, secular stagnation, e-commerce, all that will continue to be present as deflationary drivers.
So Matt Miller spoke to the Bundesbank president, Jens Weidmann, yesterday. He said that the ECB must assess the fundamental cause of the rising yields. First of all, let's listen to Mr. Weidmann.
It's certainly to a large extent linked to the movements in the United States that, in a sense, affect our rates over here. In that sense, it is not linked to inflation expectations or a better economic outlook. We have to take a closer look. We have to analyze the root causes, and then decide whether we need to take action or not.
So, Mr. Constanze, given what we've just heard from Mr. Weidmann and what you were explaining quite clearly, should they look through this volatility?
Well, for the moment, yes. I think that's what they are doing. But developments in the bond market, particularly in the US, because as you know, there is a high correlation of what happens in Europe after movements in the US market. That's historically what has happened always, so it's not new, this contagion. So Europe is suffering this contagion. It's difficult to disentangle from other possible causes of this mild increase in yields. But indeed, if this continues, if the bond market in the US continues to be too nervous and yields go up even higher, then central banks have really to consider some action, starting with the Fed, I think, because the Fed, the policy is to try to have a little bit more inflation, and even condoning inflation above 2 for a while, as we know. And for that, if yields go up too much, that can hamper that objective. It's not so much.
Could we see some Mr. Constanze, could we see some coordinated action, or would the Fed, even if there's a spillover effect to Europe, the Fed would do something about it first?
Well, I expect that the Fed will move first, and Europe has to still wait because the increases so far have been quite mild. The ECB has the flexibility of front-loading interventions and purchases without changing the overall package. In the US, that would be perhaps have to do with an increase in purchases. And the Fed, in my expectation, perhaps will be forced to intervene earlier if this continues and attains more significant higher yields. Otherwise, central banks will try to explain that also the market should see through the bumps in inflation this year and think about the structural reasons why during 25 years we have had inflation around 2, and in Europe an average that is below 2, And in spite of the bumps, inflation will still this year be below 2, although higher than present forecasts.
Thank you so much, Vitor Constancio, their former ECB Vice President and Professor at the University of Navarra School of Economics and Business Administration. Now, coming up, we speak to the UK Shadow Chancellor, Annelies Dodds, on what she makes of Chancellor Rishi Sunak's budget announcement yesterday. This is Bloomberg.
I have asked the Securities and Futures Commission and the Hong Kong EX to work.
Okay, day traders, we have to move further of a stop on profit for euro, and I'm going to move to 120.50.5. So if you follow this trade, please do so. Please follow this trade until the end. Don't try to be a hero and do your way. If you get the strategy, you know what is supposed to be done, and you know how it works. Okay? So stop on profit moved to 120.505. If you want to get the strategy, you can go on our website, company.co.uk, or you can get on the red line. You see that the address is published there. Yesterday we had a webinar, it was workshop. So if you're interested for next week, you can register next week on Wednesday, I think. There will be again workshop or course, webinar, whatever you can call it. And you will get the strategy and you will understand how we buy, what we use, and what broker we use, how to speak, how to find the right broker, what questions you need to ask, different brokers, different strategies. And all this information you will find from our workshop. Okay? Stay safe.
Whatever it takes. I have done, and I will do so.
Spend now, pay later. That was Rishi Sunak's message in his annual budget. The Chancellor will keep spending high to help the economy through the pandemic crisis. Now, a cut to VAT, furlough payments, and the stamp duty holiday will all be extended. But he also plans to raise taxes to the highest level since the 1960s in the coming years. Well, joining us now is Annelies Dodds, the UK Shadow Chancellor. Thank you so much, Annelies Dodds, for joining us. Now, pre-budget, you were saying actually it's dangerous if we hike taxes now, or if the Chancellor hiked taxes now to then cut them right before the election. This is not the case. This is actually quite a big gamble from the Conservative Party. Is he just doing the right thing?
Well, I don't think he's doing the right thing by families, because actually they are seeing their council tax increase very substantially by up to 5% in many cases. That's the wrong decision. Of course, we'll wait and see what he does with taxation into the future. And there were those rumours swirling around that actually he was planning to make increases just so that he could cut them before the next general election. You know, I think the most significant thing from this budget is the assessment from the OBR that the UK has had the worst economic crisis of any major economy, and relating that then to the handling of the health crisis that we've had in the UK. And really, we should have seen a budget which was facing up to those challenges for the future, seeking to secure our economic recovery. I'm afraid we didn't see that in many cases yesterday.
So what would you have done differently? I mean, it seems that the furlough programs are extended. There's a lot more support, certainly, than we had first heard about. And the vaccinations are coming. And actually, it seems that the government, by all accounts, is doing a far better job than most G7 countries.
Well, it hasn't, unfortunately, done that better job by our economy, because we have now had confirmed by the Office for Budget Responsibility that the UK has had the worst economic crisis of any major economy, of any country in the G7. And that's been linked, as I said, to the health situation that we've had here, the fact that we've had high levels of infections, that we've had high levels of hospitalisations, that we've had long lockdowns that have been more intense. And Labour, for example, called for earlier measures to be taken, for a circuit breaker to be put into place. The government did not adopt that. Now, we do welcome some of the measures in this budget, but we wanted many of them to have been announced many weeks ago. For example, around the business rates holiday and the VAT reduction. If the Chancellor could have made those announcements earlier, it would have prevented a huge amount of reduction in confidence for particularly small businesses that are really struggling at this time. Some of them will have let staff go because they couldn't see the future and they didn't know what was happening with those programmes. So the Chancellor should have acted earlier.
Do you accept that if the vaccination programme is a success, this economy in the UK could actually reopen faster than other economies?
Well, that's what we're all hoping to see. And I have to pay tribute to all of those NHS staff, general practitioners, the family doctor staff, all the volunteers who've been involved in this effort, and of course all of the scientists as well, some of them in my own constituency in Oxford. They have done an incredible job so far. We need to make sure, of course, that that vaccination programme is maintained, that it's intensified so that we really do get the population vaccinated as quickly as possible. And obviously, I hope that that will then be linked to reopening. But we need to make sure that happens right across the country. And I am concerned that we could see a return to the autumn in the UK, where we had rolling restrictions imposed in different parts of the country, particularly in the north of England. We really cannot see that into the future. That would be immensely damaging.
If you look at universal credit, how will that actually change? Could we see a reversal from the Chancellor in 4-6 months?
Well, I think that's the concern, that the Chancellor has heeded calls from the Labour Party and from others that we need to see that £20 uplift maintained. However, he's only extended it for 6 months until October. Now, of course, the problem with that is that most experts would suggest that the peak of unemployment in the UK may be taking place at around that time. That means it will be really hard for people to, for example, increase their hours, earn more money so that they could offset that reduction in support. So the Chancellor really should be facing up to this. He should be clear that he would maintain that uplift until he can actually sort this system out, get social security fixed in the UK. Our system has been shown to be internationally an outlier. It really hasn't covered people's costs. It hasn't functioned well during this crisis.
Annelies Dodds, if Labour were in power, could you envisage cutting corporation tax?
Well, I would say that actually we've been not in support of the government's approach, the Conservative-led government's approach over the last 10 years, when they've successively cut corporation tax rates back, and that hasn't resulted in the investment growth that we needed to see. What we've got right now from the Conservatives is a kind of handbrake turn, so they're rapidly increasing corporation tax. Of course, they've had to introduce a really significant investment tax incentive at the same time to stop that rapid increase, resulting in investment being pushed back so it could be counted against tax in the future. We would have had a longer term approach to this, a more sensible approach, one which wouldn't have cut that tax rate back so much in the first place.
Thank you so much, Annelies Dodds, there, UK Shadow Chancellor. Now, Smart Conversations on Bloomberg Surveillance, the early edition. Up next, we speak to the Chief Executive of Binance, the world's biggest cryptocurrency exchange. Do you have any questions for him? You can IB us on IB Plus TV Go, or you can also tweet me. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Well, investors turn cautious on Bitcoin. The cryptocurrency dips below the closely watched 50,000 mark. Up next, we speak to the chief executive of the world's largest crypto exchange. Spend now, pay later. That's the message from Rishi Sunak's annual budget. The shadow chancellor tells this program Sunak has failed to protect the most vulnerable. And explosive progress. SpaceX's latest mission ends in a fireball, but Elon Musk still calls the launch of the largest ever rocket from the U.S. soil a success. Well, good morning, everyone. I'm Francine Lacqua here in London, and this is Bloomberg Surveillance Early Edition. So let's talk crypto. In the last half an hour, Bitcoin has dipped below $50,000 after topping the key value again yesterday. Last month, Elon Musk called the digital coin a less dumb version of cash, and the Tesla chief executive was defending his company's decision to invest $1.5 billion in Bitcoin. Well, Musk's tweet was in direct response to an interview with the Binance chief executive, CZ, on Bloomberg TV, and he was wondering why Musk invested so much on Bitcoin if he's so gung-ho on Dogecoin.
I'm surprised that Elon's so gung-ho on Dogecoin, but I think, look, this is the free, decentralized free world, right? Anybody can like anything. He can like Dogecoin for any reason he likes. And I strongly believe that he's not really associated with Dogecoin in any way. The fact, though, is that Tesla, I think, bought Bitcoin, not Dogecoin. Mm-hmm. So I think Elon probably likes it a lot personally.
Well, Binance is the world's largest cryptocurrency exchange. The company has come to dominate the market for crypto derivatives, and yes, it trades Dogecoin as well. Well, joining us now is Binance founder and chief executive. He's CZ. Thank you so much, CZ, for joining us. I have 1,000,001 questions as we try and understand a little bit more about all of this world. First of all, how has your user changed? What kind of portfolio do they have, and how will these portfolios evolve?
So I think our users, number one, the total size of user base is growing very rapidly, especially in the last year, and especially more in the last couple of months. We've seen much more higher uptake on institutional adoption. So we have a lot more institutions coming in. They typically trade much larger sizes. We've also seen the corporate treasury coming in. Those guys have a very unique buying pattern. They buy over long periods of time, well, long meaning like weeks or months, and then they just buy and they don't sell. So, and they buy, they withdraw, they buy, they withdraw. So we've seen that pattern, which is quite new. I think probably mostly promoted by MicroStrategy. Right. So yeah, we've seen those type of patterns, which are quite new.
So, CZ, what's the average account size? And actually, where do they make the most money from?
Actually, the average account size we have not calculated because we do have a long tail. So there are many sort of retail users with low balances. So I think the average is probably not that high. We service users from all over the world, including some of the less economically developed regions. We have accounts which holds like $100, $50, and they think that's a lot of money for them. So I think the average is probably pretty low, but the top, the big institutions do contribute to the majority of the volume.
CZ, when you look at Coinbase planning to go public in the U.S., there's so much speculation about further IPOs in the crypto space. Would you IPO Binance?
We don't have any plans to IPO Binance, so we don't have it. That's not on our roadmap. I think IPO is really great. It validates the industry to have a crypto exchange going through a U.S. IPO. I think that opens the door for many other crypto businesses. But fundamentally, Binance right now, we're not looking to fundraise. We're self-sufficient. We're not growing so rapidly. We're growing pretty quickly, but our costs, we manage them pretty carefully, and so we're able to fund our own growth. And we also have the BNB token, which is very liquid. So so yeah, we're not looking at IPO, but I think the Coinbase IPO is great for the industry.
The nominee for the next SEC chief was saying this week that actually keeping the crypto markets free of fraud is a real challenge. What kind of regulation do you think is needed?
So I think, yeah, so it is a real challenge. I don't think there's an easy way to do it. To be honest, if I was a regulator, the most normal thing would be to bring the traditional financial regulations to crypto first, and then try to adopt it for the crypto industry, because crypto is a little bit different from the traditional financial industries. I think basically now most of the regulators recognize that you want to be forward-thinking to adjust regulations so that we promote innovation, but at the same time protect people from fraud and scams. And so it's a really challenging job to do. But I think the current new regulators are sophisticated enough to understand this, and they're pushing this in the right directions now.
I mean, how important, if you look at the rally that we've seen in crypto, how important has a margin that exchanges give actually crypto traders been a factor in this rally?
I think the margin or the lending, the leverage that exchanges give actually should not impact price up or down, because they actually work both ways. They're guys who wants to short, but they're also guys who wants to go long on leverage. So I think the fundamental price rise is actually caused by more buyers. There's just more buyers in the market, and also so there's more people coming in into the industry. The industry size have grown. So I think that's the more fundamental key.
You know, given the margins, these large margins, and the regulatory requirement, is there a risk of default at one of the large exchanges if there were outflows and drawdowns? Is it something that you worry?
Yeah, so I can't speak for other exchanges, but for Binance, we're 100% reserve exchange. So we the users deposit their funds onto Binance, and we hold them in reserve. We don't use that money for anything else. So it's 100% covered. There's really no margin on that. The margin trading and futures trading, where we give users more leverage, they took the leverage on us. So if something happens, then we would the exchange can be in a financial loss. But the risk management systems are relatively well tested. So I don't think that's a problem. I don't foresee that to be a problem. There's always a little bit of a risk there, but I think it's relatively very low. Yeah.
Zizi, there's so much, of course, appetite for some of these crypto, and we see players like PayPal looking at maybe the crypto space. We look at, I think, the CME actually group also looking at it. Is that a challenge to a company like Binance if more players get involved?
No, absolutely not. I think it's great for us when more and more players join, either traditional financial players or new ones. The industry is so small right now, we just need more businesses in this space. So any traditional business that joins this industry, they can bring a lot more users that we couldn't touch before, we couldn't reach before. So they probably have like much traditional investors that wasn't into crypto before, and they provide an on-ramp for those guys to come into crypto. And then those guys can potentially use us for other services that we offer they may not. So we offer a wide variety of futures products or crypto products like derivatives or earning, interest rate products, etc. So most of the other traditional providers don't have that kind of crypto product suite. So the more players, the better.
And do you, with the rise of crypto ETFs, does that take business away from you?
No. Again, I think the guys who buy ETFs do not buy on are not buying on Binance.com today anyway. And the guys who are buying on Binance.com today will not go buy ETFs. They have direct access to Bitcoin. So two different markets. The more we can get them exposed, get in, the better. Yeah.
Zizi, I'm also getting quite a lot of questions of people watching us, so thank you so much for sending us your questions. And Zizi, I have a good one saying, actually, given the fact that there's so much talk about these exchanges and crypto, do you see a consolidation in exchanges? And actually, is it a movement that you'd want to be part of?
Sure. I think there's always consolidation in exchanges, but at the same time, there's always, like every day, I think there's hundreds of new crypto exchanges going live. So exchange is one of the most competitive spaces in crypto. It's also one of the most viable if you have a proper business. So, but exchanges have strong network effects. So the guys who have large amounts of liquidity, when you buy there, your slippage is lower, meaning that your cost is lower. So you basically get much better prices, and your expenses are lower. So and more people want to trade there, and then that has a very strong network effect. At the same time, the most exchanges users multi-home, so they use multiple platforms at the same time, most of them. So there's less stickiness. So we got to maintain a very superior product, superior service, which, to be honest, we're struggling a little bit given the huge influx of users now. But the exchanges do have a strong network effect, and they will have consolidation effects as well.
Cici, can I also ask you about crypto derivatives, right? And this is basically like Bitcoin futures. We had the UK regulator saying that they had concerns about this. Again, what does it mean for Binance?
So that just means we cannot provide services to crypto derivative services to UK users. So we respect the regulations, and the regulators make the rules for their jurisdictions, and we just got to respect it. We do want to work with regulators all around the world to show that, hey, some of these products, if you regulate it well, you can actually allow it. So different regulators in different countries allow different things. Crypto derivatives are not banned in most other places. So, but it's good to have different type of regulations in different places, so that this way we can see which one works better, which type of regulations have risks, and then as a whole, people learn from each other, and we can improve. So it's still very early days. I think most regulators are still experimenting. Well, they probably will not use that word, but in my logical sense, they're experimenting with different regulations, and they will adjust them over time. So I think it's okay. It just means that we can't provide that service in UK for now.
I have a couple of other questions, and one person, writing in saying, what's the best sector for the next months, DeFi or NFT? Do you have any thoughts on that?
That's always a really, really tough one. To be honest, like even if you asked me 2 weeks ago, I would not have predicted one of the NFTs sold for $6.6 million from Beeple. So I spoke to him like last week. So those are really, really hard to predict. So my philosophy is I never predict the future, but whatever is trending, we try to support it.
Talk to me a little bit about Tether, Cici. I know it's definitely been in the news. Are you now happy that it will go? Are you happy with the way that it's settled now?
I think it's great because that was always like a dark cloud that's hanging over everyone's head, because Tether is one of the top 5 crypto coins by market cap, even though it's not pure crypto. So it's great that now they actually have some kind of a settlement or agreement where at least that kind of settles that part of it. So I think that's great. That increases the peace of mind for users in crypto, and Tether is the largest stable coin in the industry, so now people have a little bit more comfort. I don't know all the details of Tether. I have never audited the bank accounts. I don't have a special relationship with the issuers, etc. So I'm just like a user. But I think that's what's positive for the industry. What's positive for one player is positive for the industry.
Cici, thanks so much for coming on. I hope this will be a regular occurrence. The Binance founder and chief executive there talking to us about Binance and everything crypto. Now, coming up, the UK and the EU battle over Northern Ireland again. The bloc is threatening to take Britain to court over a potential breach of international law. We discuss that next, and this is Bloomberg.
Nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
nation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, the EU says it's going to take legal action against the UK for breaching the Brexit deal. Well, less than 6 months after Britain said it was going to break international law in a limited and specific way to break the stalemate in withdrawal talks, Boris Johnson is once again vowing to take unilateral action on Northern Ireland. This time, the government says it will extend a waiver on trade rules for food entering the country until October. Now, the UK described the move as temporary, but drew ire from European Commission Vice President Maros Sefcovic, who said this constitutes a clear departure from the constructive approach that has prevailed up until now. Joining us now is Ian Wishart. He's our European politics reporter in Brussels. Ian, first of all, how big a deal is this? Is, I know the two sides kind of fight, but is this a huge fight or is this a coming and going fight?
I think certainly in Brussels they see this as the first step maybe to what will become a big fight, I think, Francine. There's not much trust between the EU and the UK. After all the wrangles they had last year, and as you said, the threat to break international law Boris Johnson did last September, this is actually quite a narrow thing that they're doing, something very specific about the agreement on the Northern Ireland deal, but it represents something bigger. What it represents is the UK not wanting to stick to some of the rules that is agreed to, and the EU say, well, we can't let you get away with that because you agreed to those rules just like we wanted you to, and they're there for a reason. So I think, from the EU's point of view, they see this as quite a serious breach. They're talking about legal action, they're talking about infringements, and, what it really means is just, this is just a terrible start to the post-Brexit relationship between Britain and Europe.
Thank you so much, Ian Wishart, there, our European politics reporter. And of course, the story will run and run, so we'll continue bringing you the very latest headlines. Now, the SpaceX Starship manages to land, but then explodes. Despite the mishap, the test is likely to signal progress for the company's biggest rocket. So we discuss that next, and this is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's
world's second largest port. The industry accounts for 7% of the country's GDP. But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
So if it was a slightly little faster...
Whoa, 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 whoa!
Oh my God.
There you go.
There's your methane leak.
Yes.
There's your...
Folks.
Boo.
Well, explosive progress. SpaceX's latest mission ends in a fireball, but Elon Musk still calls the launch of the largest ever rocket from the U.S. soil a success. Well, joining us now is Bloomberg's Matt Bloxham. Matt, I mean, we were watching this, and it was pretty extraordinary, and of course, the commentary there of some of the presenters says it all. How does Starship fit into the overall SpaceX program?
Yeah, hi, Francine. Yeah, I mean, obviously, it was an explosion, but successful. At least they landed the rocket this time. The last two exploded whilst they're trying that maneuver. So Starship is the next generation of rockets. They're currently using a system called Falcon 9 to put satellites up into space. Starship will essentially allow them to massively increase the payload, but also take people potentially to the moon and then on to Mars. So this is really kind of critical to Elon Musk's plan to send humans to Mars in the kind of next 4 to 6 years. It's also critical to the Starlink program in the midterm because of the significantly bigger payload it can take. It can potentially take 100 people or up to 400 Starlink satellites. The current system can take about 60 Starlink satellites into space. So it would be a massive ramp in the capacity to send things up into space.
Matt, thank you so much. We'll have, of course, plenty more on SpaceX and, of course, some of the other satellites it's also launched. Our Matt Bloxham there looking at the space industry. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lyons joins me out of New York. We'll talk about markets. We'll talk about treasuries. We have some great questions for Stephen Major of HSBC. He's really the bond guru when it comes to treasuries, but also some of the European fixed income things that we're seeing. And a little bit later, we also talk to Morten Sorrell about the UK budget. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We are on the cusp of being able to fundamentally change the nature of this disease.
It is now the task of politics to take the next steps. They shouldn't throw us back and lead to a dramatic third wave.
Much has changed, but one thing has stayed the same. I said I would do whatever it takes.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lyons.
Well, good morning, everyone, from London, Berlin, and New York on this Thursday, March the 4th. I'm Francine Lacqua with Matt Miller and Kaylee Lyons. Matt, it's all about bonds. I'm so excited to speak to Steve Major, actually, the bond guru, the bond ninja, because it'll be interesting to have his take on what we saw in the last 10 days and actually in the last 13 hours. Treasury is certainly stable now, but it wasn't the case yesterday.
Yeah, absolutely. There's been a lot of question about the liquidity in that market. It's a $21 trillion market, so you'd expect a little bit more stability. And a question about what's pushing rates higher. Is it growth expectations? Is it inflation expectations? Is it a mix of both? I, too, am very excited to speak with Mr. Major.
General excitement. Victor Constancio actually was also saying watch for liquidity because he's concerned about that. Kaylee, what are you seeing on the markets?
Well, I too am excited to speak to Steve Major in just a moment, but I am noticing not a lot of stability when it comes to the equity market. After steep losses in the U.S. session yesterday, we do look to open lower in about 4.5 hours time at the U.S. Open. Stocks in Europe lower as well. Of course, this is a market contending with what it is seeing in the bond market, specifically selling across sovereign bond markets across the world yesterday, actually really led by gilts in the UK after the government said it is going to issue more debt than originally anticipated. Gilt yields and U.S. Treasury yields both climbed 9 basis points in the Wednesday session. That is coming in just a touch today, down about a basis point each. So some signs of stabilization, but you're still looking at a 10-year yield at 1.46%. And of course, that is the action when it comes to nominal yields, but we have to pay attention to what's happening in the break-even space as well. Inflation expectations creeping higher and higher. Looking at the 5-year break-even rate, it reached 2.5% yesterday for the first time since going all the way back to 2008. We are just off those levels now, and of course, some of that probably has to do with higher oil prices, Matt, but nonetheless, this is a market that is repricing its expectations on where prices are going to go over the next 5 years, and it will be interesting to see what, if anything, Fed Chair Jerome Powell can do to talk some of those expectations down when he speaks around noon Eastern, Matt.
Yeah, no, absolutely. That is a major move, and we will speak with Mr. Major about that move shortly. I want to just quickly look at the investment grade, high yield, and leveraged loan sectors here. The yellow and blue in this chart is high yield, investment grade and 5-year treasuries. So you've seen those rates go up. This is normalized at the beginning of the year. In tandem, it looks like that high yield has fared a little bit better, pretty much unchanged in terms of its yield from the beginning of 2021. But you can see that leveraged loans really have done well. So people who bought into this haven't really been hit. They've absorbed the big jumps in yield, Francine, that we've seen over the past couple of weeks.
Yes, so much to talk about with Stephen Major, Global Head of Fixed Income Research at HSBC, who joins us now. Stephen, first of all, congratulations on all of your notes. I love the major bond letter, and you talk in your notes also about a lesson in humility of the bond market. What did you learn in treasuries over the last 10 days?
I learned that sometimes we can be too dogmatic, and we need to be flexible, because the bond market can teach you a lesson very, very quickly. The longer term views don't change very much for me, but the longer term is the longer term. What's happening right now is that we're on the edge of a big uptick in inflation, which could last a few months. And the market's fear is that that could stick and start to feed into the longer term. Now, the tantrums that you're seeing in bond markets, that's an old word that everyone uses now, aren't the same as before. By definition, if they were the same, they wouldn't have happened. It would have been obvious. It seems to me that this is much more to do with leverage in the system. And when you think about leverage, you tend to focus on borrowed money and risky positions. And it was quite interesting what Matt just said. There's a great deal of pain being felt in the investment grade part of the credit space. And in fact, high yield and leverage loans have outperformed the investment grade. But that tells you that there's a lot of money that was sitting there just hugging the index, effectively long duration. So we're learning all the time that there's a lot of leverage, and we don't really know where it is until after it's happened, until after the correction has happened. And the market's feeling out where that leverage is.
So, Stephen, you still have this lower for longer yield forecast. What would need to change for you to change your view on that?
Well, it's very, very difficult for that to change, Francine, because the longer term structural and secular drivers include debt overhangs and demographics, and then the implementation of technology, for example. Those things haven't suddenly gone away in the last few months. They are dampeners on growth and inflation. So they are headwinds, if you like. There's no doubt that inflation's going up in the next few months. Some of this is transitory. Some of this is the commodity complexes, oil prices, etc., being so much higher than where they were last year that it's inevitable that the year-on-year inflation goes up. Now, everyone knows that. The timing couldn't be worse for the Fed, though, because they're still in the early days of rolling out this AIT, the average inflation targeting, and they probably didn't expect to have a challenge to the framework within a few months of launch. So the job is on. They now really have to communicate and let the market know that they're going to be on hold for the number of years that they've previously said, that this inflation isn't going to follow through. And I think that they'll be okay, because I'm struggling to understand how inflation lifts off after this short transitory phenomenon that we're about to see. People seem to be throwing around ideas based on money supply and previous regimes that don't really apply today. So I'm still quite relaxed, and that's why we've kept our forecasts at 1% for 10-year treasuries.
Nonetheless, the market seems to think it's going to come from somewhere, Stephen, and there have been questions about leverage, as you just said. There have been questions about liquidity in these markets, both the treasuries markets and here in Europe as well. Do the central banks need to do more? Do they need to at least show us their bazooka?
Well, something has to happen for the central banks to step in. 1 year ago, the US Fed went unlimited on its purchases. And the reason was the dysfunction in the bond market that was coming around the early stages of the pandemic. That unlimited intervention was eventually converted into QE4, as we now call it. Last week, you had a 7-year Treasury auction that was pretty terrible. And that speaks to a symptom of the underlying leverage in the system. There wasn't enough takers for that bond. And there are all kinds of things. Across global fixed income, you can meet people who will tell you stories about dysfunction and evidence of deleverage and things happening that are not supposed to. So we've mentioned IG versus high yield. Look at swap spreads. Look at the compression of all the yields at the front end of the curve, for example. Look at the break-even forwards that are going to levels that we haven't seen for nearly a decade. There's all kinds of things that are really strange. So something could give. And what's dangerous here is that people in the markets are thinking, if the Fed's not going to do anything or say anything, then there'll be a response from the market that will make the Fed do something. And that's the game that we're playing here. Everyone's watching everyone else.
Well, but for the Fed to do something, wouldn't it need to see financial conditions tighten substantially? Because even with all of the drama that we have seen over the last 10 days or so, they haven't tightened. They're still quite easy, relatively speaking.
Yeah, and that depends on how we define financial conditions, because a lot of these indices, the financial conditions indices, they tend to depend on the stock market. So as long as stocks are fine and you've got that, then everything's okay. It seems that in Europe, they're looking for something a bit more sophisticated, and that's what the ECB said at the last meeting, that they're looking into financial.
Okay, guys. Okay, traders, we're moving even further. Our stop on profit for euro. I'm going to move to 120.45.8. Let me point out where it is. Okay, 44, 45.8. Okay, sometimes, well, 80% out of 100%, it's good to hold your position overnight. See what's happened. So if you follow these trades, please do so. Please move your profit, stop on profit to this position. Speak to you later, guys.
About central banks being too academic, we'll focus on PEP and ECB next with Stephen Major from HSBC, who stays with us. Now, coming up on the program, we speak about the UK budget, but also advertising with Martin Sorrell, S4 Capital Chairman. And then later today, the ExxonMobil Chair and Chief Executive, Darren Woods. That's a conversation, of course, on renewables and dividends. That's at 9 a.m. in New York, 2 p.m. in London, and this is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective
They wanted to save lives. The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
It's certainly to a large extent linked to the movements in the United States that in a sense affect our rates over here. So in that sense, it is not linked to inflation expectations or a better economic outlook. We have to take a closer look. We have to analyze the root causes and then decide whether we need to take action or not.
That was Bundesbank President Jens Weidmann talking with me yesterday. Still with us is Stephen Major from HSBC. And Stephen, you know, the ECB had done a pretty good job of delinking or decoupling Bund rates from treasuries with Mario Draghi's, you know, whatever it takes. Does Christine Lagarde need to do something like that? Because, you know, I still think of her as the person who said it's not our job to control Italian bond spreads.
Yeah, actually, the decoupling came with the forward guidance, which was, I think, led by Benoît Cœuré. So it came after the whatever it takes. And you're quite right as to how they managed to insulate the Eurozone from the uncertainty in US money markets. And so something similar is needed. When the ECB denies that they're there to narrow spreads, or they deny that they're doing yield curve control, I, of course, tend to think the opposite, because they're very much in the business of containing spreads and controlling the curve. Of course they are. They're involved in the market every day through the PEP and the PSPP.
But if you look at what they can do, given the situation where we're in because of treasuries, Stephen, will talking down yields be enough this time, or does the ECB actually need to do more?
Well, they can do a lot more, and this is why I sort of wonder when I hear the denials about the yield curve control and possible intervention, because they are anyway active and they have a huge amount of optionality. They know ahead of the market what it is that they've got, and that they can move up and down the curve, for example, and they have done in the past, and we've seen them prefer some sovereigns to the others during certain episodes in the last decade. So they can do this, and I hear from the various speeches that it's also not just the PEP that's being looked at. Don't forget, there's the TLTROs as well, and these could be used even more because the ECB has a particular focus on banks. Don't forget, because the Eurozone economy is very different to the US. It doesn't have as much disintermediation, so it relies on the banking system to disperse loans. So the focus could be very much in a different direction. Whilst we're thinking about sovereigns and sovereign curves, the policy also needs to support the banking system so that it can help the real economy. So, you know, it's going to be very interesting what they come up with, and I'm excited. I'm very keen to see what their interpretation of financial conditions actually is.
That's on the ECB side. Elsewhere across the Atlantic, when it comes to the UK, the BOE arguably has a little bit more room for maneuver, but do you think it's likely at this point that they will be forced to go negative given the fiscal measures in the UK budget that was announced yesterday, or is there enough support for the system already?
Well, at least they have the option, and they've given themselves that option. It's a tool. It's in the toolkit. Perhaps it's at the bottom of the toolbox, but it's there. And in the US, that option isn't there. The trick is not to get boxed in. For the gilt market, it has completely repriced this year. So you could argue that they could do more QE and actually buy bonds with some decent yield now. When we came into this year, there wasn't much gilt yield at all. So the fact that the market's repriced may mean that they can use the existing tools if they need to. But it does look like they're going to have to be intervening and helping the economy for much longer, because the Chancellor has made it very clear it's going to take a long time to close that output gap. It's going to take a long time to get back all that growth that's been lost in the economy. And the further this is pushed out into the future, then the longer the support is needed. And I look at the UK and I think, well, surely some of that applies to the US as well. But anyway, we'll find out.
I wonder if we can go full circle, Stephen, back to the chart I brought up in the A block. What do you think if 10 years are going to go back to 1%? What do you think about investors who are chasing yield, picking even maybe leveraged loans? I mean, what is your best what's your best idea right now for somebody who needs to put money to work and wants to get some real yield?
Well, yeah, the challenge is that a lot of people are already fully invested, so they don't have sufficient dry powder. So the advice, I guess, is to make sure you've got dry powder, you've got some cash for when these opportunities come, because now there are opportunities. And if you go towards the ultra-long segment in the US, you're going into a part of the curve that is relatively stable. It's the belly of the curve, the 5 to the 10s, that's really moving around. But the long end seems to be gripping. You mentioned the credit investors, and you mentioned two complete extremes there. I think that the loans market, of course, is excited about there being a change in interest rates in the future. And of course, by definition, this is more towards a kind of floating rate product, which is the polar opposite of the fixed rate bonds. So I guess the demand is there because there's a huge diversification, because people are thinking, well, if I'm wrong on this trade, at least I'll be right on this one. What would concern me is the investment-grade corporates, because investment-grade corporates are such a coming into the beginning of this year, and many people were sitting there taking the carry and roll, and in fact, all they were doing was taking a huge duration trade. And I look at the attributions of total return in 2020, credit investors were really paid by their duration position. So it was a rates call, really. It's really about rates. And so they were extremely exposed. And that's why high yield has actually outperformed. In fact, high yield has a positive return this year when IG does not.
All right, Stephen, it's great. I know it's a broad spectrum in this market, but you're the best person to get to talk about the overview. So I really appreciate you joining us. Stephen Major is the global head of fixed income research at HSBC. Coming up, Lufthansa CEO Carsten Spohr. That interview coming today. This is Bloomberg.
Catch highlights from the City Lab Global City Summit this weekend on Bloomberg Television. The conversation surrounding cybersecurity, urban planning, and transportation. Plus, special guests, U.S. Department of Transportation Secretary Pete Buttigieg and Vice President of the United States, Kamala Harris.
Cities big and small are the heartbeat of our countries.
The City Lab Global City Summit this weekend on Bloomberg Television and Bloomberg Quick Take. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now let's get straight to the Bloomberg First Word News, and it now looks likely that the Senate will not pass President Biden's $1.9 trillion pandemic relief bill until the weekend. Lawmakers delayed the start of the debate while they are awaiting an official cost estimate on the latest version of the bill. Donald Trump is telling allies he's strongly considering another run for president in 2024. Well, Bloomberg has learned close advisors want him to choose someone other than Mike Pence as his running mate. Pence rejected his boss's appeal to overturn his re-election defeat when he presided over the count of Electoral College votes. OPEC and its allies are keeping oil watchers guessing about their next move. While the market has been expecting the cartel to increase production at today's meeting, analysts say OPEC Plus may deliver a smaller increase than expected. Now, coming up, we talk about the UK budget. We'll also maybe talk about space with Martin Searle, S4 Capital Chairman. We'll talk to Sir Martin not only about corporate tax increases in the UK, but we'll talk maybe a little bit about Brexit. And then we have a great story for you on Amazon and NFL. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, the early edition, and here are some of our top stories. Markets brace for volatility ahead of another appearance from Fed Chair Jay Powell. Stocks and futures slide. Rishi Sunak keeps up crisis spending in his budget, but keeps an eye on the future with a plan to raise taxes to the highest level since the 1960s. Plus, explosive progress. Well, SpaceX's latest mission ends in a fireball, but Elon Musk still calls the launch of the largest ever rocket from the U.S. soil a success. Well, good morning, everyone, from London, Berlin, and New York on this Thursday, March the 4th. I'm Francine Lacqua, Matt Miller, and Kaylee Lyons also here. March the 4th, I think there's something about Star Wars. Never mind, Matt, the force is strong with Treasury volatility.
Yeah, Treasury volatility, but really it goes across the fixed income universe. And I was actually looking at gilts because obviously you got the new debt plans yesterday from Rishi Sunak, and Stephen Major was just telling us he thinks there's been a structural change in the gilt market this year. If you take a look at what's happened with yields, there was a big jump yesterday, and maybe not as much demand for UK debt considering the new plans. In any case, that's what my focus was in terms of the UK budget.
Yeah, a lot of the focus, of course, on fixed income. Kaylee, what else are you seeing in the markets?
Well, Matt's talking about gilts. That really led a global sovereign bond sell-off yesterday. In the Treasury market, that is stabilizing a touch today, but equities don't seem to be getting any kind of positive feedback from the stabilization in the bond market. The stock 600 over in Europe down a full 1% at this point, and futures pointing to a lower open here in the U.S. NASDAQ 100 futures off by 0.7%. This index is now down 8% from its peak last month, sitting at a 2-month low, even as bond yields come in about 3 basis points. Still, though, sitting around 2.25% on the 30-year yield. Of course, the bond market waiting to hear from Jerome Powell around noon Eastern time. The oil market, on the other hand, waiting to hear from OPEC and how much supply it is going to add back on to the market. Brent crude lower by about 0.7% ahead of that decision. And whether or not it's chalk it up to the move lower in oil or the broader risk-off tone, it does look like the energy sector is going to be under some pressure today. The Energy Select Sector SPDR, that ETF, is lower by about 1% in the pre-market, even though energy was the outperformer during the sell-off yesterday. And of course, another ETF we've been paying close attention to is ARK Innovation. Cathie Wood's flagship fund is down 20% from its peak, lower by another 2.5% this morning. And two other individual movers just to pay attention to: outsized in the pre-market, Vroom lower by 13% after forecasting a wider than expected loss, and then Okta down by about 11% after announcing it's buying Otho in a $6.5 billion all-stock deal. Matt.
By the way, you know how I love wise words of wisdom from people like my boss, Al Mayers, or my idol, Tom Keene. My mentor, Matt Winkler at Bloomberg News, always says, show, don't tell. And I'm going to do that right now with the gilts. The move in the 30-year was pretty astounding yesterday. Check out this chart that goes back to the beginning of December. You had the biggest jump that we've seen since 2020. So I can say last year now, although it was only 4 months ago. In any case, this is the structural change I think that Stephen Major is talking about. We could be moving, Francine, now in a new orbit in terms of UK yields.
Matt, I love that. It's quite a triumvirate of wisdom that you were talking about there. Now, spend now, pay later, that was Rishi Sunak's message in his annual budget. Now, the Chancellor will keep spending high to help the economy through the pandemic crisis, but he plans to hike taxes on businesses and more than 2 million people to begin to pay the bill.
Our economy has shrunk by 10%, the largest fall in over 300 years. Repairing the long-term damage will take time. Much has changed, but one thing has stayed the same. I said I would do whatever it takes. The furlough scheme will be extended until the end of September. Business rates cut, VAT cut, stamp duty cut. Total fiscal support from this government over this year and next amounts to £407 billion. Without corrective action, borrowing would continue at very high levels. In 2023, the rate of corporation tax paid on company profits will increase to 25%. I said I would do whatever it takes. I have done, and I will do so.
Well, joining us now to talk about the UK budget is WPP founder and S4 Capital Chair Martin Sorrell. Sir Martin, thank you so much for joining us. I know you envisioned and had said many times that you want some kind of UK, on Thames, a little bit like Singapore. What does tax rises in the future for corporations mean?
Well, I think, to be fair to the Chancellor, he did three things yesterday. One, he tried to protect or continue to protect people, businesses, society with the virus. Secondly, he outlined plans about how he's going to pay for the subsidization during that period. And the third thing, he started to implement or talk about the implementation of things that would result in a Singapore on Thames or a Singapore on a London on steroids, on a Singapore on steroids type approach. And the Lord Hill report, for example, the free ports that he talks about, the levelling up, the reconstruction bank or the restructuring bank, these are all examples of the measures that he's taken. So I think, to be fair to him, in a very difficult situation, he did those three things. He protected or tried to continue to protect people. He looked at what needed to be funded and how it was going to be funded in the future from 23 onwards. And he looked to the future in a post-Brexit world of trying to stimulate investment. I mean, the super deductions, true, corporation tax would rise in 2023, but there will be super deductions, the sort of thing that we see in America, what we used to see in the UK of accelerated depreciation. So on balance, I think it was a good approach, Francine.
The Chancellor was also, wanting to basically change the rules, relax some of the rules to attract more IPOs and SPACs. Does that help businesses in the UK across the board? Does it help your business?
Well, we have a dual voting structure. I have a control share in our structure. And so the answer to that is yes. I mean, we could choose under the recommendations. We have to see how the recommendations unfold and how they're accepted. We could either stay as a standard listing and seek entry to the indices, or we could go for a premium listing with the control shares or the dual class remaining in place for 5 years and then being released. So there will be options open to us to stay as we are. I think now they were called standard listing, mainstream listing under the recommendations. So we have to see how that shakes out. But I think it does help with fintech, with green companies, with digital companies such as ourselves. We're a royalty on the growth of digital transformation or digital advertising. And I think there will be strong measures. The SPAC side of it, I'm a little bit less enthusiastic about. I looked at SPACs when we started S4 a couple of years ago. I thought the promotes were too high, the fees were too high, the delay too great. And of course, investors had a veto right on the investment. So I think with SPACs, I'm a little bit more suspicious of that. But I do think the dual class structure should be permitted, because I think high-tech companies, the founder owners like to retain control for the long term. And there's method in the madness. Owner-controlled companies do better in the long run.
I have to say, I love the idea that SPACs, Sir Martin, allow retail investors to get into a PE type of situation that they wouldn't normally be able to afford. It's been called the poor man's private equity because, of course, it allows you to get behind someone whom you trust, whom you are excited about in terms of investment acumen and ideas for growth.
No, true. There are other ways, Matt. I mean, we're working with Robinhood. Robinhood is a an extremely good example of a company that democratizes investment. Some people think too much. Some people think not enough. No, I disagree with you. I think SPACs, there may be excesses in terms of the way that they're structured. I recall in the last few weeks, people talking about they were interested in the long term, but when you looked at lockups and the structure of the transaction and the promoter fees and the pipes, the further financing, I'm not sure I'd agree with you. I think it might lead to some speculative excess. On the other hand, I think dual class structure, I happen to believe that those companies that are run by founder owners, where you have a ownership and control melded together, end up being run better than companies where you have a split, total split ownership and control.
Martin Sorrell, thank you so much. We're also getting a couple of questions on, why do a SPAC if you can IPO and things like that. So we'll talk a lot about that shortly, and we'll talk a lot more about the advertising industry as well with Martin Sorrell from S4 Capital. Now we continue with Martin Sorrell of S4 Capital. We look, of course, at digital and even Amazon, some of the content production, what it means, for example, for NFL games and all of the infrastructure around advertising for that. This is Bloomberg. What kind of leader are you?
I'm a leader that works on figuring out destinations that we should aim for and then chooses the direction.
Friday is Jobs Day on Bloomberg Television, the first full jobs report under the Biden administration. What will it mean for the new stimulus package? The February Jobs Report, Friday morning at 8:30 on Bloomberg Surveillance.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, I want to take a look at the advertising industry because the landscape has changed dramatically since the start of the pandemic. According to PQ Media, advertising spending in 2020 fell about 7% in the U.S., even as consumers spent about 6% more on media. Now, that advertising spend is expected to rebound in 2021, but where that money is going may look a little bit different. If you look at the way advertising dollars were spent, the way spending increased and decreased in the year 2020, the spending in cinema, out-of-home, newspapers, radio, TV, all traditional media sources fell the most. Where the spending uptick was in social media and online video. This is according to WARC data, and they also surveyed advertising spenders as to what their spending plans were in 2021. They found that 70% plan to invest more in online video, 60% more in mobile and online search, but that is going to come again at the expense of traditional media. Television budget spending, for example, is expected to fall 7% in 2021, Francine.
Yeah, except for surveillance, we're safe. Kaylee, thanks so much. Kaylee Lyons there with a great roundup of where advertising dollars are going. Now, for more on this, let's get back Martin Sorrell from S4 Capital. Martin, before we get on to actually some of the advertising space, I want to ask you about SPACs, because a viewer wrote in and basically wants to ask you what you give up if you put a SPAC or if you launch a SPAC versus a pure IPO launch.
Well, the pure IPO process is slower. It's more tedious for companies, and you have to present a longer term record. From an investor's point of view, I think there is probably more safety in the IPO process, and the SPAC process tends to be more of a shortcut. And I think, as we talked in the previous segment, the sort of promotes that people talk about. I was talking to somebody yesterday. Promoters talk about 20%. As their cut of the SPAC. In fact, in reality, it turns out, on average, I was told to be about 8%. But even that, in relation to the fees that bankers and lawyers, etc., charge in an IPO, is on the high side. So I think investors have to be very choosy about which SPACs they follow and which they invest in. I mean, Matt was saying it's a way to democratize. That may be true, but you may be going a little bit too far. So I think investors have to be more careful with SPACs and more choosy.
Where do advertisers want to advertise at the moment? Matt saw this great story actually looking at Amazon, the fact that it's also looking at streaming NFL games. Are we seeing a lot more of these, streaming services, and is that where the dollars are going?
Well, Kaylee gave a brilliant summary of what's happening. The only thing last year, what happened, the ad market, about 500 to 550 billion worldwide. It was probably down about 10 to 15%, but traditional, that's print and TV and magazines and free-to-air, was down probably about 15 to 20% or 10 to 15%. Digital was actually up probably a little bit now, somewhere, depending on whose forecast you believe, somewhere up to 5%. Our revenues last year from a smaller base were forecast by the market. We haven't reported yet. We report in later on in March. Our revenues are forecast to be up between 15 and 20%. And in Q3 of last year, we were up 23%. So we're accelerating into Q4, which we continued, and obviously into 2021. And that reflected, Francine, the growth of digital. Digital is now over 50% of that 500 to 550 billion. This year it will grow by 20%. By 24, it will be 70%. So that's where the money is going. Amazon is a really good example. Their NFL, I mean, welcome to the new world. Amazon, Facebook, Google, the platforms, Alibaba, Tencent, TikTok, are all going to be competitors for the traditional buyers of sports rights. So stand by for more.
I'm pumped about that. I hope I'll be able to watch Thursday games for $11 a month. Sir Martin, I wanted to ask you about the longer-term view on digital, because when I think about $2 to $4 trillion infrastructure package in the U.S., the possibility of that, I'm thinking about roads, airports, tracks. But when I talk to people in the market, Mark Ganzi, for example, from Colony, said, no, it's all about digital. This is about a 5G buildup. This is about reaching people who don't have broadband. How does the world change?
Well, significantly. I mean, you just, again, summed it up, just like Kaylee did, you just did. And 5G and the investment in 5G will speed, internet speeds will increase. And as a result, COVID, in its way, I mean, if there is anything good, and one can see very little good that came out of COVID, maybe the rapid development of vaccines was one of the things. But what we saw in COVID is an escalation of digital transformation and disruption at the consumer level. We're educating our kids online. We're shopping online. 30% of U.S. households buying consumer goods, food and essentials for the first time. online financial services, new entertainment and games, that's one thing. Secondly, the media. You know at Bloomberg that COVID has really escalated the trends, decline of traditional newspapers and magazines, free-to-air TV under pressure, rise of the streamers, right. Disney Plus, probably the most successful new product launch of all time. And then finally, enterprises, companies are transforming far more rapidly. So escalation of digital transformation as a result of COVID, very much to the fore.
Martin, thank you so much. I don't know about, educating our kids online. We're all trying to do it, but I'm not sure how much they're learning. Martin Sorrell, the other chairman, as for Capital, yeah, I'm trying my best. They still can't probably write their names. Later today, a conversation with ExxonMobil chairman. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Now, social isolation has been a big source of stress during this pandemic. The arts, especially music, have the power to soothe and connect people. Bloomberg's Janet Wu takes a look at two groups in Boston that are creating music to cross many divides.
Freedom is coming. Freedom is coming. Freedom is coming. Oh, yes, I will.
Music is a universal language. For 3 decades, a Boston choral group has been singing in the spirit of unity, even as a pandemic keeps us all apart. They're called the Halalisa Singers.
This name comes from the Zulu word celebration.
Director Mary Cunningham says the group was founded as a musical expression against apartheid.
I do like to tell people at the audition that you will be singing in many languages. They're like, okay, no, I really mean sometimes 11 different languages in a program. We've got people in their 20s. We've got one of our founding members is in her early 80s.
The Landmarks Orchestra also has an inclusive mission.
Landmarks has never charged admission for anything that we've done, so that's part of our accessibility magic.
Conductor Chris Wilkins creates concerts with unique collaborations, like this Korean concerto that included drumming and choreography. Landmarks also partners with Boston's museums to highlight art, themes, and moments in history.
Museum of Science, it was the 50th anniversary of the moon landing.
And when the pandemic hit, the orchestra forged on, putting musicians on rooftops with drones overhead to unite a city in lockdown. The message, no matter where you are or where you are from, music can always be experienced together.
During this time of so much political division, why can music help unite people?
Music is a miraculous vehicle because of its non-specificity. There's nothing you will hear around policy when you're listening to a piece of music, but you will feel this feeling of shared experience.
Creating that experience is what drives these organizations forward. Even with the challenge of closed venues and no ticket sales, they have gone online where audiences can both appreciate the music and support their mission.
You've got people singing in harmony, and that metaphor goes a long way. When you sing, you are connecting.
And music has the power to connect, even from a distance. In Boston, Janet Wu, Bloomberg News.
Janet Wu there showing us the power of music. Now, the power of J. Powell is probably what everyone's watching for a little bit later, and that certainly may move Treasury yields, Matt.
Yeah, absolutely. I'm also watching a rotation that's pretty incredible as oil, Kaylee, really takes over in terms of leadership. Coming up on in the next hour, Chris Marangi from Gabelli Funds. He's the co-chief investment officer there. An interview you don't want to miss with Tom, John, and Lisa.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks...
Okay, ladies and gentlemen, we sold our position on euro at 120.45.8. Well done, guys. We did a good trade. we just hold it overnight. We purchased yesterday at evening, what about 6, 7 o'clock, and we made a good profit. Well done, good trade.
Global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's going to be a very difficult dance for the Fed, and actually a very difficult dance for the bond market.
There's a real battle, I think, going on between what the market thinks will happen and the Fed wanting to say, look, hold your horses.
Unlike last year, those checks may be coming at a time when the economy is reopening.
There are real base effects coming through here that gives the optics of inflation being much higher than it really is.
It's not a straight line higher. The year finishes pretty good, but there's a good correction along the way.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Waiting for Chairman Powell from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. With equity futures down 0.7% on the NASDAQ. Tom, big tech struggling the last couple of days.
Yeah, they are. I did a chart this morning on it. I don't have it here, John, but nevertheless, it's not a bear market. I'll give it to you, but it's a little bit on the edge of a correction. We're not there. It's worth watching.
30 days, Amazon down 11%, Apple down 10%, and this is the problem for the headline benchmark, the S&P 500, Tom. It's a struggle. It's technically challenged. Even with that rotation, you just don't get enough from elsewhere when big tech's getting hammered.
And I would link it, John, right back as you opened with Chairman Powell, back to the bond market. Obviously, everybody looking for calming words from Chairman Powell, but I'd also link it to 8:30 this morning off that ADP report yesterday. Where is the American labor economy, and does it really give us proof out to 6% GDP? That's uncertain right now.
Claims this morning, payrolls tomorrow. Lisa, does Chairman Powell lean in a little bit later today?
Yeah, how much does he reiterate what Lael Brainard has been saying, which is that they're concerned about the pace of the rate rise? Just to put into perspective how much benchmark Treasury yields have risen. 10-year Treasury yields have risen about 50 basis points so far in 2021, which puts it on pace for the biggest quarterly increase since 2016. So the pace of this, John, really getting a lot of people's attention.
A big move, and here's the story this morning. We look like this Thursday morning. Your equity market shaping up as follows. On the S&P 500, down 21. On the S&P, we declined by 0.6%. In the FX market, euro dollar 120.45, coming down a little more than 0.1%. And in the bond market, you do have some stability on a 10-year at 147.40. But even with that, Lisa, NASDAQ futures down another 96 points.
Yeah, and this is really interesting to see also some of the concentrated positions within the NASDAQ, and we'll get into that later. Today we'll be watching the OPEC Plus meeting, which gets underway at 8 a.m. Eastern. Very interesting to see whether Saudi Arabia is going to maintain some of the self-imposed production cuts in place, which was key as part of their January agreement. Russia wants to keep the production going and amp it up even more. Then at 8:30 a.m., we are going to be getting those U.S. initial jobless claims. Tom, you were talking about how this is going to be key to determine what the movement in markets could be going forward. The question is, in what direction? I mean, honestly, if we get another underwhelming print the way that we did with ADP, does that send Treasury yields lower? And does that give a boost to some of these momentum plays like the NASDAQ that we've been seeing because of the low yield environment, the idea that you'd potentially get more fiscal stimulus down in Washington, D.C.? Again, one of the biggest mysteries is how the market responds to fundamental data at a time when it is moving so quickly. And then at 12 p.m., Fed Chair Jay Powell will be speaking at that at that Wall Street Journal symposium. Very interesting to see how much he's going to push back against some of the rate hikes that we've seen that are implied by the market, yet not confirmed by anything that the Federal Reserve has said. At the same time, don't they kind of want the yield curve to steepen, John? Don't they kind of want to send a message of optimism? Because if they don't, what credibility do they lose?
I won't second guess Chairman Powell at this point. He talks in about 6 hours' time, and we'll see what he's got to say. Tom, Governor Brainerd, Presidents Daly, Evans, leaning into this a little bit, pushing back just a little bit. I wonder if he reflects that a little bit later.
I think it's a lot of navel gazing and the uncertainty that's out there. We've got a great lineup of guests, John, that are going to give us their view towards this uncertain Q2 in the United States. And to me, the great gap is GDP. John, you mentioned euro earlier. We always do that. Euro dollar matters. I look at the partition, John, this morning within the churn between euro and yen. We have a weaker yen relative to euro. In a really telling sign, it's off the radar of a lot of people, is euro Swissy shows continued weak Swiss franc. To me, that's really telling.
Touched on this a couple of times earlier in the week. Should we do payrolls estimates just quickly? Capital Economics out with 500K. So that's top of the pile right now going into tomorrow. Median estimate now, Tom, 200,000.
Yeah, well, 200,000, 188 up, and, you know, there's a churn there. I go to Citigroup and the combine under Catherine Mann at a 400,000 statistic, but really yesterday, John, with the most important comment we heard on the American economy was from Ferroli of JP Morgan looking at that all-in 6 or 7 million reemployed across this year.
Are we taking bets? Did we do that?
No, I think we're taking a pass on that.
No.
Oh, are we hard to
take a bet?
I don't want to get 242. I just thought I won't participate. There's only downside for him and all upside for me.
And you guys got to carry the weight today. I'm focused on 1 p.m. I mean, John, if you and I were in London, we'd be over in the Putney Stands on the River Thames there in Fulham. But, I mean, come on, the Tots and Fulham, both teams need to win.
Let's get this back on track. Chris Barangi joins us now. Gabelli Funds Co-Chief Investment Officer.
Dazzled.
Chris, we're not going to do London derbies and all of that stuff. Let's talk about the markets. Do I position for better growth? Do I position for higher inflation? And what's the difference between the two?
Yeah, I think you're positioned for both. Listen, Goldilocks died probably a year ago. The era of low inflation and low rates and good growth is probably over. And, you know, we're, in my view, likely to see much higher inflation going forward. The question is how much? Why are we getting inflation? Is it good inflation? Meaning, is it because everybody wants to go on vacation in August? Or is it because OPEC is squeezing us? And is it structural? And, you know, those are all questions we think about. The market obviously is very focused on the interplay between rates and inflation. And that has fed the rotation into value stocks, which has started, 6 months ago and has benefited people like us.
Chris, we have a conversation with the leadership of Exxon today here at Bloomberg. Give us your update on hydrocarbons. Gabelli is ancient for a love of industrial companies where Mario was weaned. Your thoughts on big oil?
Yeah, so listen, one of the big themes coming out of this earnings season has been ESG, environmental social governance. Everybody's talking about it. Everybody's going to write about it in their annual report. And the irony, of course, is that over the last several months, it's been these big dirty companies like Exxon who've done much better. Now, again, longer term, we'll see how that plays out. We actually just launched a sustainability fund, our first sustainability fund called Love Our Planet and People. It's our first ETF. And, we think there's a bright future for companies who are trying to go green, and in particular, big industrial companies that are trying to pivot to green. And you've seen that with GM and Dana and Air Products. And to a certain extent, Exxon, who's interestingly focused on carbon capture and sequestration as opposed to some of the other things that the other integrateds are focused on.
Chris, I want to go back to something that you said. Goldilocks died a year ago. And this speaks to the it's not too hot, not too cold, not to the fairy tale character. Well, I mean, honestly, it could get pretty morbid. I am curious, though, going forward, what that means. Who loses? Because in an everything is perfect kind of world with nothing is too hot and too cold, everything can kind of rise at the same time. Who suffers when Goldilocks dies?
Yeah, well, I think you're seeing it in what's happening with the NASDAQ. This is a perfect environment for the big growth companies, the big internet companies in particular, that don't have to show profits in the near term and whose profits in the future are being discounted at very low rates by the market. So I think there's going to be more of an impetus to be profitable, to have rational economic models, and that should favor the traditional incumbent companies, which now include probably many of the FANG, which are, enormously profitable and have very strong market positions.
Imagine being a child and tuning into this show this morning. See the banner at the bottom of that screen. What is this? You accidentally put on Bloomberg. You've got to nurse the children because they're in tears. Lisa, what is this? Chris, let's get serious.
Come on. No, honestly, this is something that people have been talking about. Yes, look, we don't want to talk about Goldilocks dying, but at the same time, the not too hot, not too cold is a question. Is a 60-40 dead? I mean, these are some of the key questions in investing.
All of that good stuff. Chris, active management now. Do you think you've got a stronger argument for that this year?
I think we do. I'm reminded, we're talking about commodities, the cure for high prices is more high prices. In the case of passive, the cure for passive in the eyes of active managers is more passive. We've seen, mindless flows driving the market over the last 10 years or more. And to the extent that we can do price discovery and add alpha, that benefits us. And I think now's the time to do it because the playing field is changed. Goldilocks, if Goldilocks is in fact dead, not everybody's going to go up.
Where in the 3 or 4 accounting statements is the alpha generator? Is it EBITDA? Is it distinctions of cash flow? What's the line that matters to the Gabelli shop?
It's clearly the cash flow statement. Cash is king. It always has been. It's not about a revenue multiple. And so that's where we're looking.
Chris, great to catch you up.
EBITDA minus CapEx.
Always good to see you, sir. Chris Marangi, Gabelli Fund Co-Chief Investment Officer. Thank you. Wells Fargo, Chris Harvey, just publishing. Risk on and small cap outperformance has turned this equity market into a stock picker's paradise. That's the kind of stuff that Chris is talking about.
Well, yeah, and Lori Calvasine at RBC Capital Markets has been just brilliant on that. I mean, I'll be honest, Lori's been maybe the strongest, most prescient analyst I've seen in, 20 days or so. And that in small caps, John, you've got winners and you've got a lot of losers who didn't have the courage to be with the growthiness that's out there. And he's right. It is about stock picking right now.
And that's that difficulty right now in this benchmark on the S&P 500. That's why we've been trapped around this 3,900 level, Lisa, even as financials rip, even as energy rips, because tech is such a heavy weighting. I know we keep going back to it. It might sound boring, but that's been the story of the last month or so.
Yeah, and definitely it's going to probably continue given the rotation that people are expecting. I do just want to say, though, with the stock picking paradise, this idea of concentration in specific names becomes more of a risk. And I think, for example, of ARK Investments, of Cathie Wood. No, I mean, seriously, when you start to have stock picking matter again, you have to start looking at who owns this stuff, how concentrated that ownership is, and what could potentially disrupt
but you're going to diversify. I feel very strongly on this, Lisa. The big risk there, and you're 100% correct about stock pickers' reality, but then you diversify away the alpha, which is what, Gabelli was acclaimed for 30 and 40 years ago. They really had a more concentrated portfolio versus owning 300 securities.
Look, on who owns this, RBC, Credit Suisse, Morgan Stanley, all pushing back on the same story, Tom, that these are under-owned stories still.
This just came in, John. This is really, really important here. Marangi with that important comment on Goldilocks as well. Lisa, I think, has done some real research here that, Goldilocks is gluten-free. I mean, the porridge is gluten-free.
Maybe your home is gluten-free. Why do you keep harping on me for gluten-free? I will say.
We are very gluten-free. John, are you gluten-free?
I'm not gluten-free.
Thank you. I'm moving in with Farrell.
I will look, just to bring it back on the rails, the whole idea of not too hot, not too cold being dead. If that's the case, what does that mean in terms of a relationship between bond yields and stocks? The idea that if yields go up, stocks go down, and then everything goes down at the same time.
This is the question, Lisa, of the first half of this year. And the bottom line is we're performance-driven, and people that take the middle ground are underperforming against that massive skew of performance in selected areas.
It gets silly, it gets serious. I don't know what the show is this morning.
John.
It's Goldilocks.
I don't know.
Hot,
is that what it is?
Did you read Goldilocks? Did you read The Three Bears as a kid?
I did. You call it oatmeal, I call it porridge.
Yeah, Goldilocks is CFA level 2. Yeah. She's working on 3.
Thanks a lot for that.
Thank you.
Coming up in the next hour. I mean, I can tease what's coming up in the next hour. I've actually got no idea what comes up in the next hour.
Goldilocks has a northern accent.
I can tell you that Phil Camporelli is going to join us. JP Morgan Asset Management, Global Allocation Portfolio Manager. Tom, this is not a northern accent. It's not. Okay, futures down 22. We're off by 0.6%.
Exasperated.
Honestly.
First time I met him, Lisa, I couldn't understand a word he was saying.
That's true, and I didn't understand you either. And we still don't understand each other now.
That's true.
This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Now looks likely that the Senate will not pass President Biden's $1.9 trillion pandemic relief bill until the weekend. Lawmakers delayed the start of debate while they are awaiting an official cost estimate on the latest version of the bill. Democrats are also making changes to the House version. Amongst other things, they'll tighten eligibility for the $1,400 stimulus checks. The British Chancellor of the Exchequer, Rishi Sunak, plans to raise the UK's tax burden to its highest level in more than 50 years. Sunak plans to keep spending big to help the economy through the pandemic, and the tax hike is needed to pay the bill. In his annual budget, Sunak made it clear that saving jobs in the coming months is his top priority. And SpaceX's newest and biggest rocket pulled off its first successful landing, but then it exploded moments afterwards. The Starship SN-10 prototype lifted off from a launch pad in Texas and flew to an altitude of about 6 miles. Then it appeared to achieve a milestone with its first stable landing in 3 attempts. Just before the explosion, 2 other Starship tests also ended in fireballs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
I think it's a big mistake. Look, I hope everybody's realized by now, these masks make a difference. We are on the cusp of being able to fundamentally change the nature of this disease because of the way in which we're able to get vaccines in people's arms. We've been able to move that all the way up to the end of May to have enough for every American, to get every adult American to get a shot.
President Joe Biden there, that was the official response to Governor Abbott down in Texas, reopening the state. and taking away the mask mandate. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Counting it down to initial jobless claims in about 2 hours' time. Payrolls tomorrow. Chairman Powell at midday Eastern time. Going into that, here's the bond market. Yields in a basis point or two to 146.53 on 10s. In the equity market, we're lower again. We're down 26 points on the S&P 500. NASDAQ futures down more so through much of the morning. We're down or off by 0.7%. 6% of the benchmark, it's Apple. Tom Keene, Apple down again more than 1% in the pre-market. Yeah, down almost 10% over the last month.
Well, they are the NASDAQ 100. I don't know what the weighting is right now. I don't have it in front of me. But, John, they're the ones getting hammered right now. And, again, we wait for Powell here later in the morning. Right now, Jack Fitzpatrick, within the cacophony of what we see in Washington, I thought I'd drill down to something that I think very few people know. There are senators out there, Strom Thurmond, 1954, and then the idea of Murkowski of Alaska, where they were primaried. They were thrown out of office by their party ages ago. Jack, you know that the senator from Alaska was primaried out by the Tea Party years ago, and she won on a write-in vote. She understands the immediate domestic politics of her party.
Yeah, and she's effectively the most independent member of the Senate, I would argue, even more than registered independents like Angus King or Bernie Sanders, because she is not tied to her primary electorate to win re-election. So the conversation now, unsurprisingly, is whether Biden can win Murkowski's vote. She has said, even though Republicans have stayed out of the negotiations mostly, that she's undecided and she wants to see if she can get some improvements. And this is going to be a habit of hers probably for the next 4 years. She also saw that when there was a close vote before Neera Tanden's budget director nomination fell through, that maybe she could play herself into some advantage, and said she was undecided on that. So Murkowski is the Republican to watch for this bill, and probably for many others.
Jack, give us a window. I know John and Lisa got serious questions. I got a question. This comes off Forbes magazine yesterday, which Zero Hedge redid. Thank you, Zero Hedge, for doing that. Of the nitty-gritty of these battles, like what would Senator Murkowski want to get out of this bill for her vote?
Probably the number one thing she'd want that might be, I don't know if it's realistic, but not even in this bill, is to get Biden to reverse his decision to block oil drilling in the Alaska National Wildlife Refuge. That's an executive issue that he could do even outside of this bill. The state aid could be improved for Alaska. I don't have the exact dollar figure of what they're going to get, but if she could tweak things to just get more money for her state, which has had revenues hit pretty hard, that's something that she could see improved in the bill.
In the meantime, Senate Democrats have pushed back the final vote for the stimulus bill, and there's a question about how much the final price tag will come to based on some of the adjustments that President Biden made to the eligibility for those $1,400 checks. Can you talk about what other changes have been made and what the expectation is for the final headline number when the Budget Committee comes back with that estimate?
So the headline number looks like it's going to be pretty close to that 1.9 trillion we've been talking about over and over again. They haven't scored it even after they took out the minimum wage portion, which I think only came in at about 54 billion. It's not a massive difference. There were other little things that got cut out because they weren't eligible for the budget reconciliation process. Some of the infrastructure stuff they wanted to do. That limitation on the stimulus checks looks like the biggest one. So we'll see how the CBO scores it. But really, this is about minor tweaks. And if it's under the 1.889 trillion level that they set as their limit rather than 1.92. So these are pretty small numbers, and it does look close to 1.9 trillion like we've been talking about for a while.
Jack, who is the administration trying to fool? This is a partisan bill. Why are they obsessed with the optics of negotiations and bipartisan efforts when everybody who's watched this play out in the last couple of months knows it's anything but?
Well, I would say they haven't been obsessed with the optics because they have basically put out a partisan bill. It would be a bonus for them to get Murkowski on and say that it was bipartisan, say that that Republicans are wrong when they accuse Biden of going back on his promise to work across the aisle. But really, the optics of bipartisanship have clearly not driven this because they've pushed through a Democratic bill, and I would not be surprised if Murkowski's support falls through and this ends up, as we've expected, being 50 out of 50 Democrats plus Kamala Harris as the tiebreakers. So really the focus is
maybe the word obsessed was too strong, Jack, so forgive me for that. But if you think about how this administration started, it was inviting some Republican senators into the White House to have a conversation about this bill, and then nothing happened. Does this set the tone for what happens next in the next bill, the bill after that?
That depends heavily, again, on the Senate parliamentarian, really, as to whether they can do what they want without Republicans. There is talk now. Peter DeFazio, the chairman of the House Committee on Transportation and Infrastructure, says he doesn't know if they can do this big infrastructure bill without Republicans just procedurally. So I think the answer to that is that, unfortunately, it's up to the process and all this stuff way in the weeds as to whether Democrats can legally act without Republicans rather than the politics itself.
Interesting. Jack, good to catch up. Appreciate your time early in the morning. Bloomberg Government's Jack Fitzpatrick there. Let's turn to the markets quickly. NASDAQ futures rolling over again just a little bit, down 110, 111, off by 0.9%. Tom, you wanted the weighting on the NASDAQ 100. Apple, almost 11.5%.
Yeah, well, then you add up the next 4 or 5 after it, and it's hugely tech-weighted. I mean, it's radically different NASDAQ 100 from the advent of the cubes years ago, which was a major trading vehicle. I mean, to me, it's a market churn. There's some correlation to it, John. I guess the headline story for me today is I don't have yields higher. How strange.
Yields are lower. Going into Chairman Powell, Lisa, midday, Eastern time.
Yeah, and there's an expectation he's going to push back pretty vociferously against the idea that they're going to excuse me, I will get my words out. It is Thursday, right, still? They're going to hike rates.
It's Thursday.
And the question is...
I don't know if they're going to hike rates, though, Lisa, today. That's not a thing.
They're not going to hike rates today.
But it's not 2023, 24, 25, 26.
2023 is too early, and people are basically coming out and saying that he will push back against the notion that they're going to really start raising rates in early 2023, which seems to be the bond market's inclination if you take a look at the expectations built in. There's really nothing that he's said to support that, John.
What is substantial progress? We'll get into that a little bit more. I mean, that's the line coming out of the Federal Reserve, and it's up to you as a market participant to define that too in some ways as well. If you think we'll get there quicker than the Fed, you can disagree with Fed forecast, Tom. There's this thing about Fed forecast that somehow they're set in stone. They'll be upgraded probably in the next couple of quarters by the Federal Reserve. So I think you can, as a market participant, say, this is what I think substantial progress is, and this is when we get there.
We're all navel-gazing the Fed. I would look at the GDP data. What do we do with a 6% American economic growth? We're not used to that. I really can't say enough how unprecedented that is.
Coming up on that, Danny Blanchflower, Dartmouth Professor of Economics. Looking forward to that. From New York City this morning, good morning. Chairman Powell, 12 Eastern. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. This is Bloomberg. Chairman Powell coming up a little bit later from New York City this morning. Good morning. Here's the price action this Thursday morning. Equity futures pulling back 0.7% on the S&P. The Nasdaq down again and down hard, off by 0.9%. Switch up the board. Get to the bond market. Here's the why. 27% of the S&P 500 is big tech. Big tech has really struggled as yields have drifted higher. Bit of stability today going into Chairman Powell. 10s at 146, call it 147, 30s at 224. When will we see substantial progress that the Fed needs to pull back? And is this still a statement of confidence? I think those 2 points, part of the focus a little bit later today for Chairman Powell. This is what I want to finish on, though. Tech's been upset by what's happened in yields. What next? Finish on this. Foreign exchange, commodities. Look at today, just a little bit of dollar strength. The DXY up a couple of tenths of 1%. And copper having a really hard time in London on the LME this morning.
Well said, well said.
Copper down a little more than 4.5%, Tom. And I just wonder, it's just one day. And I don't want to get too far ahead here. It's just one day. But we could see more of this, Tom. And I just wonder if it upsets the consensus trade around EM1 and commodities too.
Yeah, the ebb and the flow, and there's some real distinction here. I think our team has done a great job of different commodity voices. Francisco Blanche made it very clear he sees the metals distinctive because of China versus the rest of the broad index. We'll have to watch that in the coming days. Right now, John, this is a joy, a joy, a joy. The answer is we only have David Blanchflower of Dartmouth on after Cardiff football wins 10 in a row. They haven't lost in 10 games, which is absolutely extraordinary. So Professor Blanchflower's people have allowed him to come on air. He is definitive on the job economy. From the wage curve of decades ago to not working, where have all the good jobs gone? Danny Blanchflower, to the right and the left, owns a high ground. He joins us now from Dartmouth College, Hanover, New Hampshire. Danny, you have a chapter in Not Working where you say, where is the wage growth or the lack of it? With the government-induced inflation we're going to see, will that give us a legitimate wage growth and the good feeling from it?
Well, in a while, obviously the big reality was the wage growth was very weak. The Fed really didn't interpret it correctly, didn't have an explanation for it. A big story going forward will be what happens to wage growth. But we have a puzzle right now because during 2020 and coming into 2021, wage growth has jumped. It's jumped to about 7 or 8%, but not credible, because that's because the dropping of the low end of the labor market, if you like. So it's just a batting average effect. So watching wages is going to be really important. Measuring it's going to be very hard. But in some sense, I think, yeah, you're right. You said a minute ago, look at GDP. But I think the big deal will be look at wage growth, look at what happens, and see if it sustains itself in a way that it hasn't. And the major reason, in a sense, for that is the people at the low end have got to be lifted. They've been impacted hard by the pandemic. They didn't see really strong wage growth in the last decade or so. So I think wages are really central to all this.
Within wages being central to it, it is about jumpstarting the economy.
Right.
What is the character of 6 or 7% GDP? What kind of economy will that be?
Well, it'll be a pretty good economy. I mean, we have to put all of this in context.
Yeah, but Danny, is it an economy for the elites? The bottom line is, and the distrust is, the money's going to go to the elites.
That's exactly the concern. I mean, the K-shaped recovery, strong recovery for some, no recovery for others. And I think that's really the concern. I mean, the great thing, in a sense, that Biden has done is he's focused on it. He has two really strong appointees in Treasury and at the Council, Janet Yellen and C.C. Rouse, who said in their nomination speeches, this is what we're going to focus on. But the reality of that is it's really hard. It's really hard to bring everybody along together. I mean, look at the stock market. We've seen that's doing pretty well. Wall Street's doing fine. You've been talking about it. But the issue in some sense around the world is what happens to Main Street. And because Main Street has not done that well, this is, in a sense, the explanation for populism. It's the explanation in the US of a push to Trump. It's an explanation in the UK of a push to Brexit. So this is central to what happens in this recovery. Do you bring everybody along? In the UK, does the British Prime Minister is he able to do things for the 50 constituencies that used to be Labour that went to him to vote for Brexit? You got to deliver, and the question is, are you going to be able to? I mean, the question is what is Powell going to say about those people who are at the low end, who've been furloughed, and potentially their firms won't kickstart again?
Danny, there's a lot there. Let's unpack a little bit of it.
Sure.
This idea of, people come on this show and they say that the markets outperformed and did really well, even though Main Street lagged behind for a long time. Now we're entering a new paradigm where Main Street can perhaps do better and markets may perhaps underperform a bit. Are you saying that's hogwash, that's not true, and that's not the trajectory that we're on?
Well, I mean, I see that the central part of what we're seeing is that the Fed is going to do, and the Bank of England are going to do quantitative easing. They're going to keep doing that. That's going to push up asset prices. The question then is, how does that quantitative easing, how does that help people at the low end? The answer is relatively so it doesn't. So the focus on the Biden package is actually about jobs, helping people at the low end, and restoring employment to those who are furloughed, those who've been taking these unemployment benefits. I should just go back. So when the unemployment rate rises, we have never, as of last April, we have to 15, 20%. We have never seen wage growth rise dramatically. So why is that? The bottom 10% or so of the wage distribution dropped out. They're not working. They're furloughed. And the question is, are the firms that are furloughed actually going to reopen? And if they're not, we're in really big trouble. The government's going to have to do something about that. And we know that. We've never seen anything quite like that.
Danny,
I think the reality is that this is a big problem.
I've got to jump in, sir, and we've got to go back to your time at the Bank of England. You were at the Bank of England at that really crucial time, 06, 09, right before the crisis, coming out of the crisis as well. When you sat there with Governor King, did you tell him you don't like the idea of QE because you thought this would happen? Was it anticipated at the time when this grand experiment really got going?
Oh, absolutely not. I mean, I think the reality was that central banks were basically unprepared for having to do this. But I think the biggest thing, John, was that two things. Nobody really had a clue about the transmission mechanism and how it was going to work. And nobody had a clue how about this thing would ever end. And of course, it hasn't ended and it continues. So I think the answer is no. And the other part of it is, think of the debate going on at the Bank of England. The committee is now arguing in public about whether they think they should go to negative rates. I mean, I remember being told then that 0.5% was the lower bound. You couldn't go lower than 0.5. So the answer is this is unheard of territory, John.
Yeah.
We will see. What assets will they continue to buy? What will the Bank of England do? Will the US go to negative rates? I mean, I think Powell's made all the right noises, but the question is, do they have any ability really to impact things? And does 100 billion of QE today, are its effects the same as it was in 2009?
Danny, how do we have a proper conversation about this? Because I know from sources that when you were at the Bank of England, Governor King told you guys not to go out there and say QE won't work. Once you decided to do it, that was it. You all had to get on the same page. You don't have to tell me right now on the record whether that was true or not, because I know from talking to people, it happened. So, Danny, when are we going to have a proper conversation about whether this works or not, and not be dictated by just a couple of people who have made some big decisions?
Oh, I think the answer was, I think, eventually, by around November 2008, it was clear that you couldn't cut rates enough, and that you had to, if you can't cut the price of money, so you raise the quantity. I think it's go back to your earlier question. I mean, the answer is it's unclear what QE has done. I mean, think of what you just asked me. What has QE done? But it has to be in combination with zero or some places negative rates. And so the attempts to work out what it's done are difficult. I mean, I take the view, actually, is that if we hadn't done it, unemployment rates would have been 25%. I mean, that's the Bernanke line.
Yeah.
So I think certainly in 2008 and 2009, it worked. Probably diminishing returns set in, but it certainly seems to me to have had positive effects on stock markets. Why else is the stock market rising? Because there's this giant buyer of assets that's out there. So I agree with you. Looking back, basically we had no idea what to buy. So do you buy 10 years, 15, 5? So the Bank of England bought pretty long stuff that didn't mature very quickly. So it's not just what did QE do, but what should you buy? What are its impacts? What duration stuff do you buy? So all of that's still in the air. And the answer is that when you're floundering, you have to do everything. So I think, and Powell has been cautious, and I think sensible, more sensible and cautious than people at the Bank of England. Haldane said inflation is going to take off based on no evidence. So I think the story out of the Fed, looking back, saying they got 2015 to 18 wrong, which I said on your program, I think every month for 3.5 years. So I'm hopeful, but these are tough times.
Danny, good to see you. Always good to catch up. Danny Blanchflower, Dartmouth College Professor of Economics. Tom, the history of this is so important, and we're still learning from decisions that were made more than a decade ago.
Yeah, to color it, John, what overhangs all of this, including the pressures that Professor Blanchflower faced with all at the Bank of England, was the Bank of Japan 15, 18 years ago made the wrong decision. And that haunts all of central banking every moment, every day. Everybody agrees with this. The Bank of Japan screwed up. There's no other way to do it. And they had to retract a rate move that's tattooed to the brain of every single academic economist.
And others repeated it, Tom. Others repeated it. Isn't that the story here? I mean, I find it amazing that on the negative interest rate experiment, for most people in markets that come on this program, they'll tell you, we don't like it, it doesn't work. Yet the academics carry on doing it. Why? And yet the academics also want to loosen up financial conditions and speak to the market participants and get them on board, but they're not.
They want a Goldilocks economy. Okay, John, my why is simple. I had the honor of speaking to Secretary Geithner about this in the heat of 07, 08, whenever it was. We are petrified of bankruptcy. We are petrified of clearing zombie institutions.
Well, hold on a second.
So we just go on and on.
There's also a fear, and John, you've highlighted this. When there's a market crash, the people at the bottom suffer the most. And there isn't a mechanism to get that back up because that's the fiscal impulse and it's been lacking.
Just the nature of policy. All through financial conditions immediately all at once, and the fiscal effort builds over time. Can't put the fiscal effort to one side too much, though. It has been absolutely humongous over the last 12 months. More still to come. Coming up, Jason Farley, Johns Hopkins University nursing professor from New York City this morning. Good morning. This is Bloomberg.
With the first word news, I'm Rishika Gupta. The Senate isn't likely to approve President Biden's coronavirus relief package until the weekend. Lawmakers are waiting on an official cost estimate of the latest version. Plus, Democrats are tweaking the measure that was passed by the House. The president agreed to moderate its demands to tighten eligibility for the $1,400 stimulus checks. The U.S. has speeded up its coronavirus vaccination program. In the last week, an average of more than 2 million doses per day were administered. So far, more than 80 million shots have been given in the U.S. That's about 24 shots per every 100 people. And Federal Reserve Chairman Jerome Powell is likely to push back today on bond market doubts about the central bank's policy. Skeptics have been questioning whether the Fed will be ultra-patient in pulling back its support for the economy. Once the pandemic has ended, Powell will make an appearance at a Wall Street Journal webinar. OPEC and its allies are keeping oil watchers guessing about their next move. The market has been expecting the cartel to increase production at today's meeting. Analysts say OPEC Plus may deliver a smaller increase than expected. And Lufthansa has posted a record $8.1 billion loss for the year, and it says it will struggle to break even before the end of 2021. The pandemic has forced Europe's largest airline group to dial back capacity plans to a level where it's unlikely to make money. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
40% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds of the global economic recovery.
Catch highlights from the City Lab Global City Summit this weekend on Bloomberg Television. The conversation surrounding cybersecurity, urban planning, and transportation. Plus, special guest, U.S. Department of Transportation Secretary Pete Buttigieg and Vice President of the United States, Kamala Harris.
Cities big and small are the heartbeat of our countries.
The City Lab Global City Summit this weekend on Bloomberg Television and Bloomberg Quick Take.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Just a little over a week, Texas had this massive natural disaster from the ice storms and the power outages. And so vaccines in many cases are delayed into arms, and some had to be wasted because of that. So there is a delay in public health activity there. So turning off all of the things that we know work right now is really unfortunate.
Lawrence Sauer there, Johns Hopkins University Assistant Professor of Emergency Medicine from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Thursday morning, initial jobless claims, 8:30 Eastern. Then Chairman Powell, 3 hours and 30 minutes after that. In the equity market right now, we're down 0.5% on the S&P, a break of 3,800 and down 20 on the session. In the bond market, stability yields in 2 basis points. Your yield on a 10-year, 145.84. Here's the number that matters, though, Tom. In the last week, the average doses per day in America, the average vaccine doses, 2.01 million. They're the numbers we want to see.
Over the 2 number, folks. What was that, John? 1.6 originally? 1.6, something
we were at
like
900K when the president took office.
And now then 1.6-ish, and then it crept up, folks. In this course, 2 million numbers. Hugely specific. At Bloomberg, we have headlines from all over the world, and they come streaming in. We see them. Lisa reads them all. I don't, to be honest. And there at 3:49 this morning was the nation of Hungary saying, I'm sorry, it's not working. Partition of Hungary, and what we've heard from John Ferro about the troubles of Europe in this horrific pandemic with what Texas is doing. Jason Farley, the Johns Hopkins School of Nursing, joins us right now. Professor Farley, I can honestly say in my amateur walkthrough of science, I've never seen a division so wide. How do you respond to further draconian lockdowns in Europe versus the nirvana of what we see from the governor of Texas?
Well, good morning, Tom. It's certainly a confusing state of affairs for those of us in the scientific community. The Hungary had a green light for quite a while, planning on returning a lot of normalcy to the country by Easter, was the original prime minister's plans. And then a case report, particularly in old folks' homes, retirement homes, that showed 1,200 new cases in a single day, 9 deaths.